Good morning. The committee will come to order. Without objection, the chair is authorized to declare a recess of the committee at any time. This hearing is entitled "The Examining Regulatory Burdens from a Regulatory Perspective." Before I begin, I'd like to thank each of our witnesses for traveling all the way to Washington, D.C. and to the Visitor Center. Not only is it a long way to Washington, D.C., but it's a long way to the Visitor Center, so you get double credit for your efforts this morning. This hearing is starting a little bit earlier than normal today because this was originally scheduled to be a full work day, but now is a getaway day, and we're going to have votes, fortunately, later in the day, morning than I anticipated, so there'll be around 11:40 or 12. So it should give us time to, I think, have a pretty robust hearing. And at this time now, I'd like to recognize myself for 5 minutes to give an opening statement. Today, this subcommittee will continue its examination of the regulatory burdens facing community financial institutions and the resulting impact on the American consumer. The Financial Services Committee has heard an overwhelming amount of testimony highlighting the plight of our Main Street financial institutions that are disappearing at an average rate of one every single day. We have heard from hardworking Americans in communities across the country that they are losing their financial independence. These consumers face difficulties in obtaining mortgage credit and the threat of financial products disappearing. Each one of us in this room has an obligation to our constituents to take seriously regulatory reform for these institutions and the American consumer. Unfortunately, some of my colleagues on the other side of the aisle and in the upper chamber have suddenly changed course in their efforts to work in a bipartisan manner. Curiously, we have seen bills that were bipartisan last year that have been very difficult to pass this year. We've seen Democratic-led bipartisan bills that passed out of our committee blocked on going to the floor, all in an effort to protect Dodd-Frank. As a result, Republicans are left without a dancing partner in trying to reverse this trend of too small to succeed. In my district, and I suspect in many of my colleagues' districts, this is not an option. So today I'm pleased to welcome our witnesses from the federal and state financial regulators. These agencies' representatives will provide an important perspective on the regulatory framework facing our community financial institutions. I suspect many of them have heard the same stories members of this subcommittee have heard. However, these agencies are in a unique position. They have the authority in most cases to write rules that can begin to change the condition of too small to succeed. Some have done a better job than others. Today, this subcommittee will address two overreaching regulatory issues. First, how does the supervision and examination function of these agencies impact community financial institutions, and are there ways we can improve that process? Second, how do these agency rulemaking limit the operational activities of community financial institutions? And further, how do these regulations impact consumer choices and availability of credit? Each one of your agencies holds a piece of regulatory burden puzzle that must be explored. For example, community banks have undergone significant capital restructuring as a result of the Basel capital requirements. Credit unions are in the midst of moving to their own new capital structure that could result in considerable cost. Operation Choke Point has severely fractured any trust in the supervision and examination process between financial institution and regulatory agencies. Some consumer protection rules have literally caused products to disappear, as was the case in bank deposit advance products. In total, these regulatory issues continue to drive market consolidation and to harm the experience of consumers in the financial marketplace. In closing, I'm reminded of a quote from a recent Harvard study about community banks. It stated, "Their competitive advantage is a knowledge and a history of their customers and a willingness to be flexible." I like this quote because it's the very definition of banking relationships, particularly in community banks and credit unions. In the district, in Texas 19, we need relationship banking. My constituents want to know their banker. Their local banker wants to be flexible and find ways to help his neighbor realize the dream and reach financial independence. It is my hope today that we can begin to restore some bipartisanship and work together to help our constituents on Main Street reach their financial dreams and enable our economy to reach its full potential. This committee will come to, I'm sorry, got a little ahead of myself there. The chair now recognizes the ranking member of the Financial Institution Consumer Credit Subcommittee, the gentleman from Missouri, Mr. Clay, for 2 minutes.
Thank you, Mr. Chairman. I appreciate you calling this committee, and I certainly appreciate your common sense approach to how we go forward as a subcommittee. I welcome today's testimony from our panel of regulators, and I view this morning's hearing as an important opportunity for regulators to make their case for the work that they are already doing in tailoring their regulatory approaches to the size, complexity, and risk profiles of our community-based financial institutions. In particular, I look forward to better understanding how the rulemaking process already lends itself to agency considerations of cost and benefits, the progress of ongoing agency reviews of existing rules that are already happening under the Economic Growth and Paperwork Reduction Act, the various exemptions that regulators have already extended to community banks and small businesses, and the value of asset thresholds to regulators in identifying opportunities for targeted regulatory relief. My hope is that this morning's testimony will form the basis of responsible and targeted regulatory relief proposals that strike the proper balance between consumer protection and safety and soundness, and that calibrate regulatory approaches to the actual risks that community-based financial institutions pose. Mr. Chairman, thank you again. I yield back the remainder of my time.
Thank you. Is there any other members on your side that would like to have time for opening statement? You'll have a little time still left.
I don't see any now.
All right. Then today I'll introduce our panel. Mrs. Doreen Eberly. Ms. Eberly is the Director of FDIC's Division of Risk Management Supervision. She is responsible for FDIC's programs designed to promote financial institutions' safety and soundness and those institutions' adherence to the FDIC statutes and regulations. She has had a distinguished career at FDIC, where she has served as acting deputy to FDIC Chairman Sheila Bair and acting Chairman Morgan Gruenberg. Prior to joining FDIC, she served on the professional staff of the U.S. House of Representatives, a committee on banking and financial services, and under the fellowship program during the 105th Congress. Ms. Eberly holds a BA in economics from Cornell University and an MBA from Emory. Ms. Marianne Hunter. Marianne is the Deputy Director of Division of Bank Supervision and Regulation at the Board of Governors at the Federal Reserve System. She was responsible for the Federal Reserve's program for supervision and risk management and oversees the supervision of U.S. banking organizations and foreign banking organizations operating in the U.S. Prior to joining the Board of Governors staff, Marianne held a number of high-level positions at the Federal Reserve Bank at Kansas City. She started her career at the Federal Reserve as an examiner in 1981 and was promoted to Senior Vice President and Officer in Charge of Supervision in 2000. She holds a BA from Penn State University and an MPP degree from the University of Michigan's Ford School of Public Policy. Mr. Tony Bland. Mr. Bland is Senior Deputy Controller for Midsize and Community Bank Supervision at the Office of the Controller of Currency. In this role, Mr. Bland is responsible for supervising nearly 1,800 national banks and federal savings associations, as well as 2,000 OCC employees. He serves as a member of the OCC's Executive Committee and the Committee on Bank Supervision. Mr. Bland previously served as Deputy Controller for the agency's Northeastern District, where he was responsible for the oversight of more than 300 community banks and federal savings associations, independent national trust companies, and independent data service providers. Mr. Bland received his Bachelor of Science degree in Business Administration and Economics from Carroll University in Wisconsin. Mr. Larry Fazio. Mr. Fazio serves as Director of the Office of Examination and Insurance at the National Credit Union Administration. In this role, he is responsible for providing leadership over the agency's examination and supervision program. He has had a long career in supervision and examination at the NCUA, having previously served as a supervision analyst, supervisory examiner, and director of risk management. Mr. Fazio graduated from Lewis University with a degree in accounting. He's a certified management accountant and has a master's degree in organizational management from George Washington University. Mr. David Silberman. Mr. Silberman serves as the Associate Director of Office of Research, Market, and Regulations at the Consumer Financial Protection Bureau. Prior to joining the CFPB, Mr. Silberman had a long career at the AFL-CIO, where he served as Deputy General Counsel. While there, he helped create an organization to provide financial services to union members. Mr. Silberman went on to serve as President and CEO of Union Privilege and later as Director of AFL-CIO Task Force on Labor Law. Prior to joining the CFPB implementation team, Mr. Silberman served as General Counsel and Executive Vice President of the Kessler Financial Services, a privately held company focused on creating and supporting credit card and other financial services to memberships organizations. Mr. Silberman began his career as a law clerk to Justice Marshall, and then as a member of the law firm of Breedolph and Kaiser. And I'd now like to turn to my friend from Texas, Mr. Williams, to recognize a very special member of the panel today from Texas.
Thank you, Chairman Nagelbauer. And this morning it's a privilege and honor to introduce Texas Banking Commissioner and my constituent, Charles Cooper. A native Texan, Mr. Cooper holds a BBA degree in Finance and Economics from Baylor University and is also a graduate of the Southwestern Graduate School of Banking at Southern Methodist University. Charles G. Cooper was appointed Texas Banking Commissioner by the Texas Finance Commission on December 1, 2008. Mr. Cooper began his career in banking in 1970 with the Federal Deposit Insurance Corporation in the Dallas region. His career in the banking industry spans over 40 years and includes senior-level positions in both the public and private sectors. As Texas Banking Commissioner, his responsibilities include the chartering, regulation, supervision, and examination of 263 Texas state chartered banks with aggregate assets of approximately $236 billion. In addition, the Department supervises trust companies, foreign bank agencies and branches, prepaid funeral licenses, money service businesses, perpetual care cemeteries, and private child support for enforcement agencies. He also serves as Vice Chairman of the Conference of State Bank Supervisors. The committee looks forward to Mr. Cooper's testimony. I want to welcome him here to Washington, and I yield back, Mr. Chairman.
I thank the gentleman. Each of you will be recognized for 5 minutes to give your oral presentation of your testimony, and without objection, each of your written statements will be made a part of the record. And we will start with you, Ms. Eberly. You are now recognized for 5 minutes.
Thank you, Chairman Nagelbauer, Ranking Member Clay, and members of the subcommittee. I appreciate the opportunity to testify on behalf of the FDIC on regulatory relief for community banks. As the primary Federal regulator for the majority of community banks, the FDIC has a particular interest in understanding the challenges and opportunities they face. Community banks provide both traditional relationship-based banking services to their communities. While they hold just 13% of all banking assets, community banks account for about 45% of all of the small loans to businesses and farms made by insured institutions. Although 448 community banks failed during the recent financial crisis, thousands of community banks did not. That's in fact the vast majority. Institutions that stuck to their core expertise weathered the crisis. The highest failure rates were observed among non-community banks and among community banks that departed from the traditional model and tried to grow rapidly with risky assets, often funded by volatile, non-core, and often non-local broker deposits. The FDIC is keenly aware that regulatory requirements can have a greater impact on smaller institutions which operate with fewer staff and other resources than their larger counterparts. Therefore, the FDIC pays particular attention to input community bankers provide regarding regulations, the impact regulations may have on smaller and rural institutions that serve areas that otherwise would not have access to banking services. The FDIC and the other regulators are actively seeking input from the industry and the public on ways to reduce regulatory burden through the Economic Growth and Regulatory Paperwork Reduction Act process, which requires the Federal financial regulators to periodically review our regulations to identify any that are outdated or otherwise unnecessary. As part of this process, the agencies are jointly requesting public comment on all areas of our regulations. We are also conducting regional outreach meetings involving the public, the industry, and other interested parties. In response to what we heard in the first round of comments, the FDIC already has acted on regulatory relief suggestions where we could achieve rapid change. In November, we issued 2 financial institution letters, or FILs, responding to suggestions we received from bankers. The first FIL released questions and answers about the deposit insurance application process. Commenters had told us that a clarification of the FDIC's existing policies would be helpful. The second fill addressed new procedures that eliminate or reduce the need to file applications by institutions wishing to conduct permissible activities through certain bank subsidiaries organized as limited liability companies, subject to some limited documentation standards. This will significantly reduce application filings in the years ahead. The FDIC also takes a risk-based approach to supervision that recognizes that community banks are different and should not be treated the same. This approach is clear in how we train our examiners and how we conduct our examination processes. Every FDIC examiner is initially trained as a community bank examiner through a rigorous 4-year program. As a result, each examiner gains a thorough understanding of community banks before becoming a commissioned examiner. The vast majority of examiners in our 83 field offices nationwide are community bank examiners. Institutions with lower risk profiles, such as most community banks, are subject to less supervisory attention than those with elevated risk profiles. Well-managed banks engaged in traditional, non-complex activities receive periodic safety and soundness and consumer protection examinations that are carried out over a few weeks. In contrast, the very largest institutions that FDIC supervises receive continuous safety and soundness supervision and ongoing examination carried out through targeted reviews during the course of an examination cycle. The FDIC also considers the size, complexity, and risk profile of institutions during the rulemaking and supervisory guidance development processes and on an ongoing basis through the feedback we receive from community bankers and other stakeholders. Where possible, we scale our regulations and policies according to these factors. As we strive to minimize regulatory burden on community banks, we look for changes that can be made without affecting safety and soundness. For example, we believe that the current $500 million threshold for the expanded 18-month examination period could be raised. In addition, we would support Congress's efforts to reduce the privacy notice reporting burden. In conclusion, the FDIC will continue to look for ways to achieve our fundamental objectives of safety and soundness and consumer protection in ways that do not involve needless complexity or expense for community banks. We look forward to working with the committee in pursuing these efforts. Thank you.
Thank you. And now, Ms. Hunter, you're recognized for 5 minutes.
Thank you. Chairman Nagelbauer, Ranking Member Clay, and other members of the subcommittee, I appreciate the opportunity to testify today on the important topic of regulatory relief for community financial institutions. As noted in the introduction, I began my career more than 30 years ago as a community bank examiner and eventually became the officer in charge of supervision at the Federal Reserve Bank of Kansas City. Thus, I have seen firsthand the need to balance effective supervision and regulation to ensure safety and soundness while not subjecting small institutions to unnecessary regulatory requirements that could constrain their capacity to serve their customers and communities. In recent years, the Federal Reserve has taken several measures to tailor regulations, policies, and supervisory activities to the risks of community banking organizations and to make our supervisory program more efficient and less burdensome for well-run institutions. For example, we've recently completed a review of supervisory guidance for community and regional organizations to make sure that our expectations for examiners and bankers are appropriately aligned with the current banking practices and risks. This review is likely to result in the elimination of some guidance that's no longer relevant as appropriate to current supervisory and banking industry practices. We've continued to build upon our long-standing risk-focused approach to supervision, reviewing field procedures, refining training programs, and developing automated tools for examiners to focus examiner attention on higher-risk activities, thus reducing some of the work at lower-risk, well-managed community banks. Furthermore, we've developed programs to conduct more examination work, such as the loan review, off-site to reduce the time that examiners physically spend in the bank. The Federal Reserve very recently took action to further reduce burden for smaller institutions. The Board issued a final rule that expands the applicability of its small bank holding company policy statement to institutions up to $1 billion in assets, provided that they meet certain qualitative requirements, and also applies the statement to certain savings and loan holding companies to address their burden. This expansion covers approximately 700 savings and loan holding companies and bank holding companies. Going forward, this means that 89% of all bank holding companies and 1% of all savings and loan holding companies will be covered under the policy statement. The policy statement facilitates local ownership of small community banks and savings associations by allowing their holding companies to operate with higher levels of debt than would normally be permitted. Holding companies that qualify for the policy statement are excluded from consolidated capital requirements. So in a related action, the Board took steps to relieve regulatory reporting burden for the affected institutions by eliminating the quarterly and more complex consolidated financial reporting requirements and instead required parent-only financial statements semi-annually. In addition to these actions, the Federal Reserve is participating with the other federal banking agencies in a review to identify banking regulations that are outdated, unnecessary, or unduly burdensome, as required by the Economic Growth and Regulatory Paperwork Reduction Act of 1996, or as it's also known, the AGRIPA review. We're working closely with the OCC and FDIC to seek public comment on regulations and are jointly holding outreach meetings to get feedback directly from bankers and community groups about ways to reduce burden related to rules and examination practices. To date, the meetings held in Los Angeles and Dallas have yielded some useful and specific suggestions for consideration. The agencies have also recently expanded the scope of regulations covered by the review to include those that are relatively new. We are committed to listening to bankers' concerns and working with the other federal agencies as appropriate to consider and assess the impact of potential changes identified through the AGRIPA review process. Let me conclude by saying that the Federal Reserve is committed to taking a balanced supervisory approach that fosters safe and sound community banks and fair treatment for consumers and encourages the flow of credit to consumers and businesses. To achieve that goal, we will continue to work to make sure that regulations, policies, and supervisory activities are appropriately tailored to the level of risks at these institutions. Thank you for inviting me to share the Federal Reserve's views on issues affecting community banks, and I'd be pleased to answer any questions you may have.
Thank you, Ms. Hunter. Mr. Bland, now you're recognized for 5 minutes.
Thank you, Chairman Nagelbauer, Ranking Member Clay, and members of the subcommittee. Thank you for the opportunity to appear before you today to discuss the challenges facing community banks and federal savings associations and the actions that the OCC has taken to help these institutions address regulatory burdens. I've been a bank examiner for more than 30 years, and I have seen firsthand the vital role community banks play in meeting the credit needs of consumers and small businesses across the country. At the OCC, we are committed to supervisory practices that are fair and reasonable, and to fostering a climate that allows for well-managed community banks to grow and thrive. We tailor our supervision to each bank's individual situation, taking into account the product and services it offers, as well as its risk profile and management team. Given the wide array of institutions we supervise, the OCC understands that a one-size-fits-all approach to regulation does not work. Therefore, to the extent that the law allows, we factor these differences in the rules we write and the guidance we issue. My written statement provides several examples of the common-sense adjustments we have made to recent regulations to accommodate community bank concerns. Guiding our consideration of every proposal to reduce burden on community banks is the need to ensure that fundamental safety and soundness and consumer protection safeguards are not compromised. Within this framework, to date, we have developed 3 regulatory relief proposals that we hope Congress will consider favorably. We are also undertaking several efforts to identify and mitigate other regulatory burdens through a regulatory review process. The first proposal we submitted to Congress would exempt some 6,000 community banks from the VOCA rule, as the vast majority of banks under $10 billion in asset size do not engage in the proprietary trading or covered funds activities that the statute sought to prohibit. We do not believe they should have to commit the resources to determine if any compliance obligations under the rule would apply. We do not believe that this burden is justified by the nominal risk that these institutions could pose to the financial system. We are also supporting current law to allow more well-managed community banks to qualify for a longer 18-month examination cycle. Raising the threshold from $500 million to $750 million for banks that would qualify for this treatment would cover more than 400 additional community banks. We also support providing more flexibility for federal thrifts so that those thrifts that wish to expand their business model and offer a broader range of services to their communities may do so without the burden and expense of a charter conversion. Under our proposal, federal thrifts could retain their current governance structure without unnecessarily limiting the evolution of their business plan. As a supervisor of both national banks and federal thrifts, we are well positioned to administer this new framework without requiring a costly and time-consuming administrative process. I am pleased that members of this subcommittee, including Representatives Rothfuss, Barr, and Tipton, have introduced legislation consistent with some of our proposals to provide regulatory relief to community banks. I am also hopeful that the ongoing efforts to review current regulations to reduce or eliminate burden will bear fruit. I have participated in the first two public AGRIPA meetings in Los Angeles and Dallas, where regulators heard ideas to reduce burden from a number of interested stakeholders. The agencies are currently evaluating the comments received from these meetings and from the public comment process. While this process will unfold over a period of time, the OCC will not wait until it is completed to implement changes where a good case is made for relief or to submit legislative ideas identified through this process to Congress. Separately, the OCC is in the midst of a comprehensive multi-phase review of our own regulations and those of the former OTS to reduce duplication, promote fairness in supervision, and create efficiencies for national banks and federal savings associations. We are currently reviewing comments received in the first phase of our review, focused on corporate activities and transactions. Finally, we are continually looking for innovative ways to reduce burden. Last February, the OCC published a paper that focused on possibilities for community banks to collaborate to manage regulatory requirements, trim costs, and better serve their customers. We believe there are opportunities for community banks to work together to address the challenges of limited resources and acquiring needed expertise. In closing, the OCC will continue to carefully assess the potential effect that current and future policies and regulations may have on community banks, and we will be happy to work with the industry and the committee on additional ideas or proposed legislative initiatives. Again, thank you for the opportunity to appear today. I would be happy to respond to questions.
Thank you, Mr. Bland. Mr. Fazio, you are now recognized for 5 minutes.
Good morning, Chairman Nagelbauer, Ranking Member Clay, and members of the subcommittee. Thank you for the invitation to discuss regulatory relief for credit unions. NCUA regulates 6,273 credit unions with $1.1 trillion in assets that serve 99.3 million members. More than three-quarters of these credit unions have less than $100 million in assets, and all but 227 have less than $1 billion in assets. Therefore, most member-owned, locally driven credit unions could be considered community financial institutions. Because credit unions generally have fewer resources available to respond to marketplace, technological, legislative, and regulatory changes, NCUA recognizes and acts continually to fine-tune our rules to remove any unnecessary burden on credit unions. In protecting the safety and soundness of credit unions, the savings of their members, the share insurance fund, and taxpayers, NCUA employs a variety of targeting strategies. For example, we will fully exempt small credit unions from certain rules. We use graduated requirements as size and complexity increase for others, and we incorporate practical compliance approaches and agency guidance. In short, we strive to balance maintaining prudential standards with minimizing regulatory burden. Since 1987, NCUA has undertaken a rolling 3-year review of all of our regulations, and NCUA is once again voluntarily participating in the current EGRIPRA review. In response to stakeholder comments received during the first EGRIPRA notice, we have established 2 internal working groups to consider possible changes in the areas of field of membership and secondary capital. We've also moved swiftly on the supervisory front to expedite secondary capital requests from low-income credit unions. Over the past 3 years, NCUA has taken 15 additional actions through the agency's Regulatory Modernization Initiative to cut red tape and provide lasting benefits to credit unions. This includes easing 8 regulations, including modernizing the definition of small credit union to prudently exempt thousands of credit unions from several rules. Also streamlining 3 processes, including facilitating more than 1,000 new low-income designations and expediting examinations at all small credit unions, and issuing 4 legal opinions allowing more flexibility in credit union operations. In February, the NCUA Board issued a proposed rule to further increase the asset threshold for defining a small entity under the Regulatory Flexibility Act to $100 million. If finalized as proposed, this change would provide special consideration of regulatory relief in future rulemakings for 3 out of 4 credit unions. The NCUA Board is fully committed to continuing to provide regulatory relief. NCUA is now working to ease rules on secondary capital, member business lending, fixed assets, asset securitization, and fields of membership. Next week, in fact, the Board will finalize a rule to simplify how Federal credit unions add groups to their fields of membership. Concerning legislation, NCUA appreciate the Committee's recent efforts to enact laws to provide share insurance coverage for lawyers' trust accounts and enable federally insured financial institutions to offer prize-linked savings accounts. Going forward, NCUA would urge Congress to provide regulators with flexibility in writing rules. Such flexibility would better allow us to scale rules based on size or complexity to effectively limit additional regulatory burdens on smaller credit unions. In this Congress, NCUA supports several targeted bipartisan bills. For example, we support H.R. 989 by Congressman King and Sherman to allow healthy, well-managed credit unions to issue supplemental capital that would count as net worth. H.R. 1188 by Congressman Royce and Meeks to modify the cap on member business lending, and H.R. 1422 by Congressman Royce and Huffman to provide parity between credit unions and banks on the treatment of 1 to 4 unit non-owner occupied residential loans by exempting such loans from the member business lending cap. NCUA also would support legislation to permit all Federal credit unions to add underserved areas to their fields of membership. Additionally, we request congressional consideration of legislation to enable NCUA to examine third-party vendors, a move that could provide a measure of regulatory relief. The change could easily save credit unions and NCUA valuable time by eliminating the need to mitigate the same issue repeatedly at hundreds of credit unions. In closing, NCUA remains committed to providing responsible regulatory relief. We stand ready to work with Congress on related legislative proposals. Thank you, and I look forward to your questions.
Thank you, Mr. Faggio. Mr. Silberman, you're now recognized for 5 minutes.
Thank you, Mr. Chairman. Chairman Neugebauer, Ranking Member Clay, and members of the subcommittee, thank you for the opportunity to testify today about the Consumer Financial Protection Bureau's work to strengthen our financial system so that it better serves consumers, responsible businesses, and our economy as a whole. As you know, the Consumer Bureau is the nation's first Federal agency whose sole focus is protecting consumers in the financial marketplace. Through fair rules based on research and quantitative analysis, consistent oversight and appropriate enforcement with respect to the institutions within our jurisdiction, and through broad-based consumer engagement, the Bureau is working to restore consumer trust in the financial marketplace. The Bureau does not supervise community banks or credit unions, but our rules, of course, impact these institutions. The division I lead, the Division of Research, Markets, and Regulations, is responsible for articulating a research-driven, evidence-based, and pragmatic perspective on consumer financial markets and developing rules grounded in that perspective to ensure that consumer financial markets function in a fair, transparent, and competitive manner. As such, the Bureau is committed to regulations that are carefully calibrated so that as we fulfill our mandate to protect consumers, we're mindful of the impact of compliance on financial institutions and responsive to those concerns. We engage in rigorous evaluation of the effects of proposed regulations on both consumers and covered persons throughout our rulemaking process and maintain steady dialogue with stakeholders. Congress also specifically mandated the agency to undertake a regulatory review process. The Dodd-Frank Act requires that within 5 years after the effective date of any significant rule, the Bureau must assess the rule's effectiveness in meeting the purposes and objectives of the Act and the goals for the particular rule. Beginning in 2011, the Bureau demonstrated an early commitment to addressing unnecessary burdens by issuing a request for information to help identify priorities for streamlining inherited regulations. Through that process, we pinpointed a number of areas for review. For example, we identified a requirement that certain fee disclosures that must be posted on automated teller machines was a candidate for elimination. The Bureau provided technical assistance to Congress on this issue, which took corrective action. Additionally, the Bureau identified certain requirements regarding the delivery of annual privacy notices under the Gramm-Leach-Bliley Act as potentially redundant. Last fall, the Bureau finalized a rule to allow bank and non-bank financial institutions under certain conditions to post privacy notices online instead of having to mail them to consumers, resulting in a potential savings to the industry of $17 million annually. The Bureau likewise has been sensitive to regulatory burdens in the rules we have adopted. As directed by Congress in the Dodd-Frank Act, the Bureau issued a series of mortgage rules, the majority of which took effect in January 2014. Those rules were designed to address a variety of practices that contributed to the mortgage crisis and ensuing financial meltdown. As part of the work to reform the mortgage market, the Bureau developed a set of special provisions to provide small creditors, mostly community banks and credit unions, greater leeway to originate qualified mortgages. For example, we provided a 2-year transition period during which balloon loans made by small creditors and held in portfolio can generally be treated as QMs regardless of where the loans are originated. We also provided that after that period, balloon loans originated by small creditors that predominantly serve rural or underserved areas would be treated as QMs. We then committed to a thorough review of whether our definition of rural or underserved and small creditor could be better calibrated. After undertaking considerable analysis, the Bureau recently proposed to expand the definition of small creditor by adjusting the origination limit to encourage more lending by these small local institutions. We also proposed to expand the definition of rural area to address access to credit concerns. To further address compliance costs, the Bureau has developed a unique regulatory implementation program. For example, Congress directed the Bureau to combine the required mortgage disclosure forms under the Real Estate Settlement Procedure Act, RESPA, and the Truth in Lending Act, TILA. Since our integrated disclosure rule was first issued in November 2013, the Bureau has engaged directly and intensively with financial institutions and vendors, including efforts focused on the needs of smaller institutions. We expect to continue working with these stakeholders to answer questions and evaluate feedback as the integrated disclosure rule is implemented. In closing, the premise at the heart of our mission is that consumers deserve to be treated fairly in the financial marketplace. A deep and thorough understanding of the marketplace is essential to accomplish the Bureau's mission and assure the stability of the financial system and our economy as a whole. Thank you for the opportunity to testify. I look forward to your questions.
Thank you, Mr. Silberman. And Mr. Cooper, you're now recognized for 5 minutes.
Chairman Nagelbauer, Ranking Member Clay, and distinguished members of the subcommittee, my name is Charles Cooper. I am the Commissioner of the Texas Department of Banking and also serve as Vice Chairman of the Conference of State Bank Supervisors. It is my pleasure to testify here today on behalf of CSBS on this most important topic. I have more than 45 years in the financial service industry, both as a banker and as a state and federal regulator. Over these many years, a few things have become more evident than the value of community banks. They are vital to the economy, job creation, and financial stability. I've also seen many swings of the regulatory pendulum. Extreme swings to either side are wrong. Regulators must constantly improve the way we conduct supervision to ensure a balanced approach. I would like to point out that the sheer volume of regulation confounds the best of our banks, and these regulations keep on coming. This emphasizes the importance of the ongoing EGRIPA review. This process needs to receive the priority treatment of everyone. Many times it's not the law or the regulation itself that creates the excessive regulatory burden, but the interpretation and supervisory techniques utilized. One-size-fits-all supervision that has unintended negative consequences should be curtailed. Being a bank examiner is a tough job. It requires education and experience. It also requires sound judgment. I have generally found that field examiners in local offices do an extraordinary job. The process begins to break down when the decisions are made from afar. As state regulators, we have found that community banks cannot be defined by simple line drawing based on asset threshold. While asset size is relevant, there are other factors like market area, funding sources, and relationship lending. We need a process that utilizes these factors and provides flexibility in how they are weighed and considered. CSBS commends Congress for passing a law requiring that at least one member of the Federal Reserve Board have experience as a supervisor of community banks or a community banker. We also support H.R. 1601, which reaffirms the existing legal requirement that the FDIC Board include an individual with state regulatory experience. A seat at the table will not automatically result in a right-sized regulatory framework. We must also understand the state of community banking. This is why CSBS partnered with the Federal Reserve to attract new research on community banking. This will help us develop a system of supervision that provides for a strong, enduring future for the dual banking system. In addition to banks, state regulators regulate other financial service industries. Effective supervision of our diverse financial system requires effective regulatory tools. To help accomplish this, state regulators develop the nationwide multi-state licensing system and registry, or NMLS. CSBS commends the House for unanimously passing H.R. 1480, which supports state regulators' expanded use of NMLS as a licensing system. We are also working with Congress to enable NMLS to process background checks for other non-mortgage licensees in the same efficient manner they are processed for mortgage providers. Today, there are 6,423 banks. As you know, the number decreases daily. State bank regulators have chartered and now regulate more than 75% of these banks. Regardless of the charter or agency, we are all in this together. We are stewards of the entire financial services ecosystem. We must ensure that sound judgment and appropriate flexibility are central to our supervisory approach. Thank you for the opportunity to testify today, and I look forward to your questions.
Thank you, Mr. Cooper, and I want to give this panel an A because every one of you stayed within your 5-minute time allocation, and I want that to be an example for my colleagues. We have great participation today, and what I'd really like to do is get through, at least for every member, to ask a question. So if you get to the end of your time and you ask a very long question, you're going to have to get that answered in writing because I'm going to be fairly efficient about making sure everybody stays within the 5-minute timeline. So I'm now going to recognize myself for 5 minutes for questions. Mr. Bland, first of all, I'd like to thank the OCC for being one of the first agencies to put forth some legislative proposals to help bring some regulatory relief for our community financial institutions. So let's talk about a GRIPA process, which of the Dodd-Frank rules are currently a part of that process that you're reviewing?
Chairman Nagelbauer, just recently, when we initially started the GRIPA process, Dodd-Frank wasn't part of the review. And so this month, we have agreed going forward, those rules that have been implemented will be subject to the future hearings and the comment periods. So it would be those that have been implemented are the ones that would be subject to the GRIPA process.
Can you give an example of maybe one of those that you might be looking at?
Well, there are. I look at the stress test process we put in for institutions. That's one that would be subject to review.
Well, I'm glad to hear that because I think that's an important part of that, and so I hope your other colleagues will be doing the same. Mr. Fazio, the NCUA's risk-based capital rule proposal has been one of the most commented proposals in the agency's history. You're wrapping up, I guess, what is be the second window of the proposed rule. One of the NCUA board members has questioned the rule's legality. Do you have confidence that the NCUA is getting this move to risk-based capital structure right?
I do, Chairman. We spent a lot of time with the second proposal, looking at the comments we received on the first proposal and doing additional research, consultation with various parties. In addition to looking at the policy matters, the risk weights, and so forth, we spent a lot of extra time research on the legal matters as well. Our general counsel, as well as some independent external counsel that we used, are confident that what we're proposing is within the NCUA board's authority to propose.
One of the concerns that I've heard about the new capital system is it require under a new capital structure. In particular, I'm concerned about the capital cushions and a practice where credit unions were required to hold more than regulatory mandates would go up dramatically. Can you address the amount of new capital that may be required in the practice of capital cushions?
So the concept of a capital cushion is not really a direct function of the rule itself. It's a choice that credit unions make when they're seeking to hold a cushion, if you will, or a buffer above what the minimum that is required by the regulation specifies. The analysis we've done, the analytics we've done regarding what level of capital cranes would hold to be in compliance, I'd first point out that 3/4 of all cranes are exempt under this second proposal from this rule, so it only affects cranes that are over 100 million assets, 1/4 or 1 out of every 4 credit unions. About 1,400 institutions. Of those, only 29 would see a decline in their capital levels below well-capitalized. For those 29 credit unions, if they were to solve their capital deficiency through just adding capital to the numerator of that equation, would be roughly $53 million in extra capital. So it's a relatively modest impact on those credit unions and their operations. Those 29 cranes, for context, hold $13 billion in assets. So it's a relatively modest impact currently, but it is effective in picking up outliers, making sure that cranes that have too much risk relative to their capital levels to absorb that risk are identified properly and incentivized to hold appropriate capital levels.
Thank you. Mr. Cooper, it's my understanding that states have considerable authority to regulate and to enforce the law when it comes to short-term small dollar credit or payday loans. Can you describe the authority that states have to regulate these products?
Mr. Chairman, first of all, the banking department does not directly regulate this industry. One of our sister agencies does, but generally speaking, the state authority obviously is predicated on state law, and it is one of the things it's directed to is to make sure that they are operating legally licensed, operating within their license, and also the disclosure to the customer is most important.
Just quick, Mr. Silberman, you had both research and regulations, but can you identify a state that lacks sufficient authority to regulate these products?
I see my time is up, Mr. Chairman. Do you want me to answer?
Yes, just quickly.
We have not thought about a state that does not have authority. Many of the state regulators have talked to us about problems they have with respect to Internet payday lending and lending that's done through tribal entities that are outside their jurisdiction. So there are some gaps in states' ability to regulate. But beyond that, our mission is to enforce federal law, consumer protection law, which establishes a floor for consumers throughout the United States.
I thank the gentleman and now recognize the ranking member, Mr. Clay from Missouri, for 5 minutes.
Thank you, Mr. Chairman. And this is a panel-wide question. All of you identified ongoing internal and external reviews of existing rules. How can smaller regulated entities engage regulators in expressing their specific concerns about particular rules, supervisory policies, or enforcement actions? What are the access points for smaller regulated entities seeking to inform your agency's policies, such as do your agencies have liaisons and ombudsmen that specifically address the concerns of smaller entities? And let's start with Ms. Eberly.
We do have an ombudsman, but to the GRIPRA process, we have established a web page on the FFIEC, the Federal Financial Institution Examination Council website, that hosts all of the information about the GRIPRA process. So each of the Federal Register notices seeking comment on rules is there. Institutions can submit a comment through the website. Institutions can watch the public meetings in a live webcast. It's just all there, and we encourage institutions to take a look at that and actively participate. We do find it most helpful when institutions give us specific information about how rules are impacting them.
Thank you. Ms. Hunter.
Yeah, I would only add to that that we do take the AGRIPA process very seriously. Any institution, really anyone in the public can comment on rules and regulations through that process. I would also encourage bankers to attend the sessions, and we have one coming up in May in Boston, May 2nd or 4th, sorry. Certainly there's all the information about registering for those sessions is on the website that Ms. Eberly referenced.
Thank you. Mr. Bland.
Ranking Member Clay, I was just, in addition to AGRIPA, I will talk about a few other things. We use a multi-approach process. Through our examiners, we have a dedicated examiner at each institution. And so in addition to the exam process, they're available to institutions throughout the year to be available to field questions. Supporting that examiner are a number of experts on a number of topics that we make available to bankers to help them work through these issues and concerns. We have a very robust outreach program where we bring together bankers to talk about issues of concern and guidance. We put out periodic issuances to them explaining the information that is most useful to them. But in addition to that, we also have a mutual advisory committee that meets, and we hear their concerns. They're representing the mutuals. We also have a minority deposit advisory committee where we get to hear their issues and concerns as well. We issue quarterly guidance that has been issued or rules that have come out with quick, simple explanations to community banks as well.
Thank you. Mr. Fazio.
Thank you. We actually have an office called the Office of Small Credit Initiatives that's specially dedicated to reaching out to smaller credit unions. We do training. We administer grant programs that authorized by Congress. And so there's a particular connection to that office. They do a lot of online training in addition to physical town halls. Our chairman and the NCUA board also hosts various town hall meetings throughout the year. We do an online call webinar, interactive webinar with credit unions quarterly as a method of outreach. And we also attend various other events that are hosted by the credit union trades and leagues that often have special aspects of those events dedicated to small institutions. And so we're actively reaching out to small institutions to hear what they have to say and the challenges that they face.
Thank you. Mr. Silberman.
Thank you. We have a number of vehicles, Congressman Clay. We have established a community bankers advisory committee and a credit union advisory committee, which meets regularly to provide us with advice. We have established an Office of Financial Institutions and Business Liaisons, which is a way for an access point into the Bureau and also out from the Bureau. Just yesterday, for example, that office had a conversation with a community banker in the chairman's district as a follow-up to the director's testimony here. We also have regular field hearings most months in which we go out into different communities. In each field hearing, there is always a community banker or credit union participant. But in addition, we make it a point to have a separate meeting with community bankers in the city in which we are in and a meeting with credit union representatives in the city which we are in, so we can hear not just people who come to Washington, but we go out to them. These are all ways in which we get input.
Thank you. Anything to add, Mr. Cooper?
In addition, as mentioned, the state regulators and CSBS conduct with the Federal Reserve an annual community bank symposium. This includes town hall meetings with all of our banks. We put out a survey asking for issues, what are the current issues, what are the questions, what do we need to do, and these are compiled. Last year, we had over 1,000 banks participate in the survey, and the survey is ongoing as we speak right now.
Thank you so much.
Thank you. Gentleman's time is expired. The chair now recognizes himself for 5 minutes. Mr. Silberman, you've heard the chairman's opening remarks about the number of community banks that have closed in the last several years. Is that ever a topic of discussion in the CFPB? You all wonder about that? You think it's good or bad?
Absolutely. The Office of Research, which reports to me regularly, is studying that. We monitor it. We think it is obviously a long-term trend, as I'm sure you know, that goes back at least to the 80s or 90s, and it's been continuing. But it's something we would like to. We believe deeply in the diversified.
You ever look at the impact of your regulations on that?
I'm sorry.
You ever look at the impact of the regulations coming out of your agency on that?
Yes, certainly. That's something we will be carefully looking at.
You ever critical of the processes that you've got set up?
I think we
You
try.
don't ever find any fault inside the agency. It's mostly just this long-term trend you're describing.
No, Congressman. I say we are carefully studying this. It's very early to know the effect of the rules. Most of them have been in effect for a little
Not
over a
very
year.
early for the people out there. They can tell me almost by the minute. So you never listen to those. You don't ever take those comments and say, those guys are just stretching it, or they're correct. I don't know. You ever evaluate that kind of thing?
We are doing that on a continuous basis.
Okay, just didn't get that idea when you said it's too early to assess, because they know the assessment very early. I think it is Ms. Hunter, on your testimony, page 9, you talk about the compliance reviews, so when you send your examiners out, do they spend the time on compliance or safety and soundness? Which gets the greater attention?
Well, we actually have dedicated staff for consumer compliance examinations, so they are specialists that have expertise
Which
in
gets
that
the
area.
greater attention, and if you given a certain time in the bank, which gets the greater attention?
If we look at the amount of time that they spend on the exams, the safety and soundness time spent on examinations would outweigh
Is
the
that
amount
what
of time dedicated
do you
to.
get that confirmation from the banks? Because the banks tell me. I mean, I don't. That banking industry in New Mexico is not that large, so we don't spend a large amount of our time. But every time I gather them, they say the safety and soundness is this much, and now compliance is this much. That's the reason that many of the lenders have gotten out of the real estate market. They tell me that if we misplace a comma now, we could be facing a $10,000 fine or $50,000 fine. They said used to we just would take care of it. They'd bring it to us and say you need to put a comma in here. And now then they say for a $50,000 fine, that's more than we're going to make on a $30,000 loan for a house. And so do you ever get those kind of comments, or is they just kind of just picking at me while I'm out there and kind of friendly audience sort of deal?
We do get regular feedback about the examination process.
So have you ever heard that exact thing?
But I haven't heard about the commas, but I would
tell you
say,
what, if you give me your home phone number, I'll put them in chucks with you.
I would welcome having an opportunity to talk to anyone who had an issue raised about
I hear
commas.
it pretty frequently. I'll start referring them to you since it doesn't seem to be anything that maybe has come up. You talk about that something that you want to do is encourage the flow of credit to consumers. Now, with the number of the community banks closing, and they regularly tell me that we just can't keep up with the regulations. So I would suspect all of you would have that as an outcome that you would like to have. So almost the same question that I asked to Mr. Silverman, do you sit as an agency and say, hey, we're starting to restrict flow of access of capital to the small rural markets? Is that a concern to you all? Because I guarantee you nobody from New York City is going to come out and make loans on trailer houses in the 2nd District of New Mexico. So when those small places shut down, they're shut down.
We very much are concerned about flow of credit and access to credit in any community or to populations or groups that might be underserved. And there is a direct connection between the access to financial services with that. And that's certainly something I've seen in my own experience as a community bank examiner. So when we hear from bankers, and we do,
Okay,
we hear the same things.
Let me bring up, I've only got 27 seconds left, and the chairman is not as forgiving to me as he is to himself. The CFPB had rules on rural, and they put Deming, New Mexico, which has got about one person per 10 square miles, and the same as New York City. Did you all send communications to them saying, we're alarmed because you're restricting flow out in those rural areas that you've described as urban, and they're not really urban? Did you all send a communication like that?
To be honest, I don't know 100% exactly.
Could you check that out for me?
Communication. I'd be happy to get back.
I would like to see a written trail if you're really concerned about that.
Yes.
Okay, thanks. Chairman's time has expired. We go next to Mr. Hinojosa from Texas.
Thank you. I want to thank both of you for holding this hearing this morning, and I'd like to thank the distinguished panel members for sharing their insights. It seems to me that the proper regulation and supervision of our banks requires a balancing act to ensure both the stability of our financial system and
that of banks, like our community banks, which did not cause the financial crisis, which are unduly burdened by regulation. I'm going to ask my first question to Mr. Tony Bland, as well as Doreen Eberly, and third, Marianne Hunter. Each of your agencies has expended a lot of time and resources in developing targeted regulatory relief for community banks. How are asset thresholds helpful or harmful in, one, ensuring the safety and soundness of our community banks, and secondly, in providing flexibility in the regulatory framework so as to not unduly burden community banks?
Representative, the asset thresholds are merely a pointer in terms of what may be a cluster of institutions that may have a certain treatment. For example, 80% of the institutions that we supervise are less than $1 billion in assets. And so when you look at that grouping of banks, you see some characteristics in terms of they're locally owned, locally operated, and that's the kind of a focus you put on that. But that's just the beginning of it. You have to look and see what their marketplace is like, what are the complexity of their operations, what type of staff they have, the ability of the staff, the size of the staff, and the operations of the institution. Are they pretty much brick and mortar, or are they involved in internet-type activities? So the thresholds are a pointer. Where it gets challenging, though, is when that becomes the only reference to what a bank can do or not do just based on size. So that's where this issue comes in. And so we would be wary of rules that would limit the flexibility, and that would be counter to safety and soundness or consumer protection safeguards.
Thank you. Ms. Eberly?
Thank you. I would agree. We use a definition for community banks that is focused on the characteristics of the institution. So,
would you speak up a little bit louder, please?
Yes, certainly. We use a definition of community banks that's focused on the characteristics of the institution. So similar to what Mr. Bland said, local relationship, core deposit funded, a relatively small geographic area, so that they're actually dealing with their customers face-to-face. They know their customers. For us, that's 94% of institutions under $10 billion meet that definition and have those characteristics. It's harder to define that with an asset threshold. It's easier with the characteristics of the institution and the way that it operates. I want to pick up on one thing that Mr. Bland said, which is flexibility. Where statutes have bright lines, thresholds, it makes it a little bit more difficult for us to exercise flexibility. One example of that would be with stress testing. And so we don't have a lot of discretion in how we apply the rules with the asset thresholds that are set.
Ms. Hunter?
Yes, I would agree. When we also, we determine a definition of community banks, we do have a threshold of $10 billion. It's really more for the convenience of being able to identify the population of banks that fall into a certain group and how we manage our examination programs. I will say that the vast majority of community banks are actually under $1 billion in assets. So in some sense, the $10 billion threshold is not where our primary focus is. I do agree that it does, hardline thresholds do limit flexibility, yet at the same time it also can be difficult. Usually whenever you draw a line and say a certain bank fits a certain category or doesn't, there's a lot of argument back and forth about who's right on the line and going over on the other side. So having a clear definition does help a little bit in just adding clarity to the group of banks and understanding where that line is drawn. I would like to add one other comment, and that is we have examiners in each of our 12 reserve banks, and as the other agencies have them local. They understand these banks, and that's part of the flexibility comes from the local knowledge that the examination teams have about those institutions, their risks, their business model, their strategies, and the strength of their management teams. And so we do incorporate that into how we think about how we supervise individual institutions.
My time has expired. I wish I had more time to ask some other questions. With that, I yield back.
Thank the gentleman. And now the gentleman from Oklahoma, Mr. Lucas, is recognized for 5 minutes.
Thank you, Mr. Chairman. And I represent an area that relies heavily on community financial institutions, and they're very critical to our economic success, both in the district and the state. and I've been very focused with them on the regulatory relief that I think they desperately and rightly deserve. And it seems like in a committee where we may not necessarily agree on a whole lot of things, I believe there's the potential amongst this group to come up with a way to provide some relief to those community banks. Now, the key, of course, is how do you achieve a definition, a consensus on what a definition should be. So I'd like to follow on my good colleague from across the line in the great state of Texas logic, and let's continue this discussion. Because right now, the way the system is working, my community banks are telling me that it's not working. I appreciate the flexibility that the Fed and the Comptroller and FDIC have discussed today. But you're taking a very small screwdriver and you're making minor adjustments in a very complicated set of machinery. My constituents believe that relief has to come if, as an industry, they're going to survive. So let's go back a little more into this definition concept. You have general definitions that have been alluded to, anything from $10 billion to $1 billion, some quantitative qualities in some of your definitions. But let's talk for a moment. How do we come up with a definition that actually provides relief out there? Some of my folks believe it should be a dollar amount because they think that just as that adjustment can help, so those minor adjustments can hurt. I appreciate the point made by Commissioner Cooper about the quantitative issues, but let's talk about that. How do we come up with a definition that provides some real relief to these community banks that we all know exist? How do we define those, ladies and gentlemen? And I ask my friends at the Comptroller's office and my friends at the Fed and my friends at FDIC, your opinion. I mean, from my perspective, going $10 billion and then giving you quantitative adjustments makes sense. But from your perspective,
I'll start, Representative
please.
Lucas. You know, I'm out a lot. One of the big part of my job is to be out talking to community bankers about the burden that they face, and this is a topic that comes up quite a bit. And it's not as singular on what a size is, because when you get into the business model, which is at essence here, I think for community banks, is what is the right business model, and have that flexibility to exercise what is a good business model. And the concern we tend to get around to is when you have a size, and then that makes a condition of what you can and cannot do, that could have limitations when you're looking at innovation in the industry. And so I think there is size to have as a start, but my point on flexibility earlier was you got to allow for innovation. And typically when there's a size, there's also conditions on what that size can do. And I think what's happening in the industry today, we have to be open to the changes that are happening in the bank and the non-bank space to allow for that innovation and growth to occur.
I would echo, and that was the point that I was trying to make in the last answer, that having a strict asset threshold without having any flexibility around that makes it difficult. It limits our ability to exercise discretion on a risk-based basis, which is how we approach our supervision. So we look at the risk of an individual institution. Before we start an examination, there's pre-exam planning that looks at what is the institution engaged in. The examination activities are focused on the activities of the institution as opposed to a one-size-fits-all.
But it almost appears in the way the rules work right now, by the general definitions of all three organizations, if your institution is $11 billion, but in every other way meets a definition that whatever that consensus might be, that it's a community bank, they're still snagged in everything. They're trapped. My perspective is, I believe in giving you the flexibility, yes, to do what you need, but when a community bank still gets caught $1, $1 billion, whatever over the limit, then they're snagged. Those are the kind of issues I think that we're trying to work our way through. Mr. Cooper, for just a moment, the only person quoted almost as often in this committee as Phil Gramm is former Fed Chairman Volcker. And recently he's come up with a concept about how to dramatically redo regulation. Could you expand for a moment from a state regulator's perspective about this concept of dramatically changing how we do our regulatory regime?
Congressman Lucas, first let me say that the Volcker proposal is still new, so we're evaluating as we speak. But a couple of takeaways we came away with recently. we're here talking about what to do about reg burden, and we don't think that that proposal necessarily helps us in that regard. Upending with the system we've got creates problems in itself. It creates a new monolithic regulator, and that we believe possibly could move us toward more of one size fits all than less. And also it gives the Federal Reserve, who we do support in bank supervision, it gives them quite a bit of authority that we feel like may be too much for one individual agency.
Thank you, Mr.
Thank the
Chairman.
gentleman. And now the gentleman from Georgia, Mr. Scott, is recognized for 5 minutes.
Thank you very much. This is a very interesting hearing, very helpful. I want to start off on where Mr. Lucas and Mr. Hinojosa left, because I think that is the problem. And you can't really solve a problem until you define it. I mean, we got community banks, we got regional banks, then we got too big to fail banks. In other words, we have these titles, but we don't have the definition. You don't define, if you can't get your hands around the problem if you don't adequately define it. And do you define it by size or complexity? Now, I think that was a part of the root of the problem that we had in Georgia. Now, as many of you know, Georgia led the nation in bank closures. And my good friend from Georgia, Mr. Len Westmoreland, and I pulled together a big event down in Georgia where we brought the Federal Reserve, and I think some of y'all know about that. We brought the FDIC, the Office of the Comptroller General, all the bank examiners, to find out why in the world, what happened that my state of Georgia led the nation in bank closing for over 4 or 5 years during the mortgage breakdown. You all familiar with that? Are you all familiar with that? I want to know what happened there. Lynn and I consistently complained that we have not gotten reports on it. So I want to make sure that if you all can respond to that now, if you're familiar with it, perhaps, but your bank regulators were there. Now, part of the problem was indeed that our Georgia banks, as many banks did over-leverage in their portfolios in terms of real estate and mortgage, as did the whole country, did the whole industry. But something strange happened down there. And we discovered that when you all came down there, and we had the big hearing. Len and I together cover about 25 or 26 different counties. And in these areas, it's the community banks that are the lifeblood of those communities. So unless we define community banks, unless we can come up with those reasons, we really are not getting our hands around it. So I just want to say, do any of you have any comment? Are you familiar with that report? What happened? I'd like to know what the impact. Our banks were saying the bank examiners didn't give them time. They weren't aware. They were over-regulated. They didn't understand the complexity of the rules. So there was some blame put at the feet of the FDIC, the Office of the Comptroller Currency, and the Federal Reserve as to what happened. You all familiar with that in Georgia?
Yes, I'll start. One of the problems with the financial institutions in Georgia is that as a group they were heavily concentrated in acquisition, development, and construction lending. When the real estate market took a turn and mortgages, property values dropped dramatically, projects that were midstream became difficult to finish because there was nobody to buy the finished product. The values had dropped. And that kind of concentration and saturation in a very tight market of that kind of product in that kind of market environment is largely what caused the problem.
All right. I'd just like to ask, I know we have a representative of the Federal Reserve here, and we have a representative of the FDIC, and we have a representative of the Office of Comptroller Currency. I'm sure both my colleague Len Westmoreland and I would love to get that report as to what is going on there. As I said before, the community banks are the lifeblood. They're sort of in the middle. So, Mr. Bland, I want to go back to you. How would you define right now, if somebody had to ask you right now, in 25 seconds I got left, what is a community bank? What would you say?
My first response would be, TIP tends to be locally owned and locally operated. But I'll go back to what I said before about where we stand in this industry today and looking forward with the innovation that's happening in there. And so a lot of it's the scale, it's the type of products that they offer. But to your point about how we would approach it is, I think it's important to look at our supervisory process. At the OCC, we have a separate community bank program that I oversee. And so our primary focus for the people that report to me that I work with is on community banks. And so we look at those institutions separate and apart from the large banks, our approaches to our policies and our procedures. And for each institution, we take a customized view of what we need to do there. So we have a supervisory strategy that is focused on at each individual institution.
Thank you very much. Mr. Chairman, I'd just like to say that it might be helpful for the full committee. This was a very good hearing down there. If we would ask the Office of Comptroller, the Federal Reserve, and FDIC, if they would get that report and their findings, conclusions, and recommendations of what they did in Georgia at our hearing, I would appreciate it.
I think that message hopefully has been delivered today, Mr. Scott.
All right, thank you.
Now turn to the gentleman from North Carolina, Mr. Pittenger, for 5 minutes.
Thank you, Mr. Chairman. Mr. Silberman, right here on your right. Yes, sir. Mr. Silberman, how is the Community Financial Protection Bureau funded?
Under the statute, we receive a percentage of revenue of the Federal Reserve System.
Yes, sir. So you're not funded through the budget. When you need money, you call the Fed and they send you a check. Is that it?
There's a certain cap, but up to the cap, we have a claim on money from the Federal Reserve
Yes, sir.
System.
How much is that cap annually?
I would have to get back to you. I'm sorry, that's not my area of expertise.
About maybe 600 million.
I was going to say
600 billion.
I was going to say 500. I was going to say 500, 550, but I'm not.
650 billion.
I
something like that.
think we should get back to you. But I would have, if I had to quote a figure, it would be 550, but I'm not sure that's right.
Okay. Well, thank you for that. You stated that you would like to see reform in the system. You're responsive to businesses. You're responsive to banking stress systems that are out there that do not allow the access of capital in the market. Is that correct?
Our focus is on consumer protection, not on safety and soundness, but certainly those are two sides of the same coin.
Yes, they are. We passed a bill yesterday that would have been an advisory board for small business and allow that board to have a voice. Now, you mentioned that you do go out in the market and you talk to people and you're listening, but there is no requirement for the credit unions for you to meet with them, or you can voluntarily if you so choose. And of course, there isn't a position to this point on the CFPB for the voice of small business, and that was the interest of this bill yesterday. There was a cost that was set up for this board that was about $900,000 a year. Pretty nominal amount of money, I think, for having the necessary input from this important element. We're in an economy right now that's struggling. It's growing at 2.2%. We've got 20 million people that are underemployed or unemployed, and much needs to be done to get us to the desired objective. And certainly, as we've all heard today, community banks, smaller banks, institutions of all sizes are important to help us address economic growth and the access to capital. Do you think it's a viable concern that we have a voice from the business community on the CFPB?
Well, Congressman, the Bureau tries not to comment on pending legislation. So really all I can say on that is that we have been very careful to make sure that we have, as I indicated, a community bank advisory committee, a credit union advisory committee, an Office of Financial Institutions and Business Liaison. We have a consumer advisory board, which is a very diverse.
But we don't have one that's specifically related to the input of business. Do you believe that this amount of $900,000 a year. $9 million over the course of 10 years is really negligible as it relates to the ability for the CFPB to draw down $670 billion a year. I mean, a sizable amount of money spent just on your innovation so far, $200 million, waterfalls and glass staircases, and we've heard a lot. I'm told more than any hotel in Las Vegas. This is an important element, but just in terms of the dollar ratios, do you think this is really just a negligible amount of money that really shouldn't be of consideration?
Well, Congressman, as I said, we try not to comment on pending legislation, and certainly if that question will be better directed to the folks who are responsible for our finances than to me.
Thank you for your input on that. Ms. Eberly, I've had a number of comments from smaller banks in my region, and I'd just like to read you one very, very quickly. Here's one bank, less than $50 million in assets and 10 employees. They come in, they want 3 to 4 weeks advance to tell us the materials to forward to them. When we get started, they're on site. Their daily work that they put in is 8 to 10 examiners are there. They take 2 to 3 weeks. These are institutions with less than $50 million. They said, you know, if any corrections are to be done, it takes several weeks and months to do this. And they said, you know, we're spending a larger and larger amount of our time on compliance. We can't meet the needs of our customers. Is that a concern to you?
I'm going to ask Ms. Eberly to respond to that question in writing because I think it's a more complex answer. And now I'm going to go to the gentlewoman from New York, Ms. Maloney, for 5 minutes.
Thank you, Mr. Chairman and Ranking Member and all of the participants today. And I'd like to ask Mr. Bland, I'd like to ask you about the OCC's liquidity rule and specifically about the treatment of municipal bonds in the so-called liquidity buffer that banks hold. As a former member of the City Council, I know firsthand the importance of municipal bonds. They allow states and cities to finance infrastructure, build schools, pave roads. They're incredibly important to city government. Unfortunately, in the liquidity rule, the OCC chose to include some corporate bonds in the liquidity buffer, but completely excluded municipal bonds. The OCC established liquidity metrics for corporate bonds so that if a corporate bond meets all the metrics, then it can be included in the liquidity buffer. But for some reason, the exact same deal was not extended to municipal bonds. Now, it's my understanding that the Fed has already recognized this inconsistency and is working on a proposal to establish liquidity metrics for municipal bonds. But the OCC is still refusing to consider giving relief to even the most liquid municipal bonds. So my question, Mr. Bland, I'd like you to consider 2 identical bonds, same size, same maturity, same everything. Both bonds are liquid enough to satisfy all of the liquidity metrics in the OCC's rule. But one bond was issued by a corporation and one was issued by a local government. Under the OCC's rule, the corporate bond would be considered a high-quality liquid asset, but the municipal bond wouldn't, even though they have the same exact liquidity. So my question to you, Mr. Bland, is do you think that that is a fair outcome?
Representative Maloney, first let me say we support institutions having a diversified portfolio of investments, which includes municipal securities. And it's important for banks to participate in the investment in municipalities for the purpose they serve, the support to local and state municipalities. The question you raise pertains to the liquidity coverage ratio, which is subject, our largest institutions are subject to, and not our community banks. The rule addresses asset classes and not looking at individual issuances. And so as an asset class, our experience and the data we've had has suggested that when stressed, municipal securities do not have the secondary market that corporate securities would have. And so the issue is around the class of assets, not an individual issuance of any kind, but more our experience by looking at this category of type of investments.
Okay, I'd like to ask Mr. Cooper, and I noticed that Texas signed on to a 43-state investigation that wrapped up last week, which imposed a $5 million fine on New Day Financial, a lender that targets veterans for mortgage loans. And the settlement agreement concluded that New Day violated MLS rules of conduct by teaching to the SAFE test. They had at least 20 employees take the SAFE Act course on behalf of others. This was a complete lie, and including the CEO and COO, and lied to investigators about their knowledge of these actions, all in connection with New Day providing SAFE Act courses in-house to their own employees. And I've been warning about this practice of in-house SAFE Act courses for years. I've written many organizations about how it is a conflict of interest, and others on this committee, including Ranking Member Clay, have also warned that CSBS about this practice, but CSBS hasn't done anything so far about this, and it appears that New Day is allowed to continue to provide these SAFE Act courses in-house. So, Mr. Cooper, my question is, will you commit to having CSBS brief me, my staff, and other members of this committee, Mr. Clay and others, and anyone who's interested, on this investigation, and explain what CSBS is doing in response to what is a big scandal?
Certainly, Congresswoman, we will do that. I will tell you that the announcement of the settlement is a process that the states went through the multi-state mortgage committee that we have in order to try to deal with issues like this. We do think it sends a message, but we will certainly look into other things.
Thank you. I have 4 seconds left, and I wanted to ask Ms. Hunter the same thing on the liquidity metrics that Mr. Bland, if you could get back to me in writing. I'd appreciate it. I saw the article today in the Wall Street Journal that you're moving on it. Thank you.
And now recognize the gentleman from New Hampshire, Mr. Genta, for 5 minutes.
Thank you, Mr. Chairman. I want to thank the panel for your testimony and your willingness to come today. I'm going to make a brief statement then, and I wanted to ask Mr. Eberly a few questions. So, community financial institutions have testified multiple times before our committee that they have not caused or been the root cause of the financial crisis, but that they're being burdened by regulatory requirements as if it were the case, and that is a concern of mine. New Hampshire is a small state, 1.3 million people. We have a rather significant community financial institution, small lending community financial institutions in our state. And I have, over the course of the last several years, had the pleasure of meeting and spending time with many of them. And I think they do a great job, whether they're credit unions or small community banks. But after a lot of the discussions that I've had with CEOs, presidents, executive teams of these institutions, I'm actually very discouraged and remain discouraged by some of the things that I've been hearing relative to the regulatory burdens. This is the single issue that I hear about from institutions in New Hampshire more than any other issue. So I have brought up in previous committee hearings some examples of these particular challenges. And I was a little surprised to hear Richard Cordray be shocked that these small institutions were being burdened. So he was kind enough to have someone in his organization call a specific bank president that I had asked them to call Piscataqua Savings Bank. And I'll get into the statistics in a minute. But, Ms. Eberly, I wanted to know from your experience in regulating these institutions, would you say that, first, it's more difficult for an institution, a small institution, to comply with the new regulatory mandates than the larger institutions?
In general, it costs more. The cost of complying with laws for smaller institutions is spread over a smaller asset base, so it costs them more.
So the economies of scale
Right.
is much easier for a larger institution than a smaller institution?
Yes.
Do you think that the number of regulatory changes negatively affected a community financial institution's ability to offer products and services to the consumer?
You know, I don't think so. I think we're seeing community institutions offer a wide variety of products, and I would just note that New Hampshire is home to the latest application for deposit insurance approved by the FDIC in March.
How many have there been in the last 5 years in our country?
Well, I can't go back 5 years, I apologize, but we had the bank in New Hampshire in March of this year. The prior one was an institution in Pennsylvania in 2012. Those are the two.
Would it be less than
since
five
well,
in the last
since the
5
crisis,
years?
since the crisis, end of the crisis.
Would it be fair to say it's less than 5 in the last 5 years, new institutions? In the
I'd have to go back to 2010. I apologize.
I would submit that I think it's probably less than 5 new institutions in the entire United States over the last 5 years. And that is a concern of mine. I'm very proud of the fact that we have a new institution in New Hampshire. It's going to be a primary bank, a great institution. And I'm very proud of that, that's in New Hampshire. What I am very concerned about is that there's only a few in the entire country, and the entire market is actually shrinking. And it brings me back to your testimony. 93% of all banks in the U.S. Are defined as community banks. Yet your testimony says that only 13%, that they hold just 13% of bank assets, yet 45% of the small business, of the small loans to businesses come from those institutions. So it concerns me greatly when I look at Piscataqua Bank in Portsmouth, New Hampshire. And let me just read you these numbers. Compliance costs, wages and benefits, $772,000 go toward compliance costs. Seminars and webinars, $11,915. Subscriptions, $38,747, for a total cost for this one bank for compliance of $823,278. That's 22.76% of their overall costs. So they have FTEs about 38. For compliance, they have 8. That seems rather unfair and unnecessary. Assuming that those figures are correct, does that make sense to you, that it's unfair and unnecessary?
I would have to evaluate that.
Time of the gentleman has expired. The gentleman from Massachusetts, Mr. Lynch, is recognized.
Thank you, Mr. Chairman. You know, I've listened to the debate here, and it's been very, very instructive. We've all seemed to struggle with this definition of community banks that weren't part of the problem during the crisis in 2008 and beyond, and the banks that needed regulation. There's a great article from this past Sunday by Gretchen Morgensen, who is you know, a continual source of wisdom on these matters. It's entitled "Regulatory Relief for Banks That Really Fail," and she talks about a proposal by Tom Hennig. He's a vice chair over at FDIC, and he has a very simple plan. And it addresses the concerns from the gentleman from New Mexico and Oklahoma and Georgia. He comes up with 4 criteria that really based on the complexity of the bank, based on the risky behavior that they have. The regulatory framework falls more heavily on those, but frees up the regulatory framework for banks for local community banks that don't engage in risky behavior. And quite simply, I'll just tell you what they are. He says that banks that hold no trading assets are liabilities. Banks that have no derivatives positions other than plain vanilla interest rate swaps or foreign exchange derivatives that get traded up front. There's no looming deadline there. No leverage. Finally, banks whose notional value of all derivative exposure is less than $3 billion. And fourth, banks whose shareholder equity or net worth is at least 10% of assets. Now, when you apply that criteria to commercial banks, out of 6,500 commercial banks in this country, only 6,100, only 400 are covered under the regulations. 6,100 are exempt, basically. When you look at the complexity of banks, the great majority of the banks that we're talking about are traditional banks. And so he also talks about the relief we could offer them. He talks about the fact that Ms. Eberly and Ms. Hunter, that we could stretch out the examination period for non-risky banks, community banks, from every 12 months to every 18 months. So you're only doing 2 examinations every 3 years instead of 3. He talks about the relief under the Basel capital standards. We could exempt a whole lot of our banks from that standard. He talks about There are only 18, he identified 18 banks with total assets of $10 billion that would also qualify. So it's not just small banks, it's big banks that don't do risky things that, that would be helped by his proposal as well. He also talks about the fact that in these simple cases for community banks, FDIC and other regulators could do the stress tests themselves rather than requiring our banks to, our local banks to engage in a very costly process. And as far as that 10% of net worth to assets, the vast majority of our community banks that you oversee are already in compliance. And a bunch of others are right on the bubble. They could get into compliance if they chose to do so. So and Tom Hennig is someone who's concerned with the stability of our banks and making sure that banks are sound. And so I've actually asked my staff, we're in the process of putting together legislation that would comply with all that. Ms. Eberly, what do you think about that? Without the benefit of having read his proposal, of course.
The Vice Chairman's proposal, it does suggest a risk-based approach to regulation, and that aligns with the approach that we already take to risk-based supervision, risk-based assessments for our deposit insurance pricing, and risk-based regulation and guidance. So I think it's consistent. I think it's a policy call for Congress. I think, we've already indicated a willingness to talk about a simpler capital approach for community banks.
Great.
The definition we use of community banks does incorporate some institutions over $10 billion by using, we have a different way of applying kind of the risk characteristics.
Okay, I want to give Ms. Hunter a crack at this as well. Ms. Hunter?
Well, I agree with all the comments that Ms. Eberly made in terms of the risk-based approach. I would add at the Federal Reserve, we are considering how the agencies might be able to do some simplification consistent with the Collins Amendment and other sound prudential practices, particularly with respect to the capital proposals that he's put forth.
Okay.
But I haven't studied the whole proposal.
Just in closing, I just want to say that the gentleman from New Mexico pointed this out, as well as the gentleman from Oklahoma, that this regulatory burden is causing consolidation. It's squeezing, it's forcing banks to merge and putting some of our community banks out of business. So we got to figure out a solution here. And I think that, with all due respect, Mr. Hennig's proposal in trying to define where that line is drawn is one of the best proposals that I've seen. And I yield back the balance of my time.
I thank the gentleman, and the gentleman from South Carolina, Mr. Mulvaney, is recognized for 5 minutes.
I thank the Chairman. Mr. Fazio, we'll begin with you very quickly. Up until about 2009, you all used to have meetings with the credit unions that you oversee regarding your budget. You stopped doing that in 2009. Why?
Chairman Matz felt that it gave an appearance of regulatory capture and that there wasn't anything productive that was coming out of the briefing. We have a very transparent process related to our budget. We post a lot of information on our website. We do discuss the budget at the open board meeting when the board acts on it. Credit unions and their representatives are free at any time throughout the year to give
Mr. Fazio, would you not agree with me that there's a difference between what we're doing here today, face-to-face, and posting something on the Internet?
Sure.
And that this is a much more interactive and possibly more productive way to spend time?
Sure.
And I would hope that folks on both sides of the aisle would agree with me that sometimes sitting down and having that face-to-face meeting is important. Sometimes uncomfortable, there's no question. But we do it. We ask you to come here and do it with us, and I think it's reasonable for us to expect you to do it with the credit unions that you oversee. Have you all decided whether or not you're going to have a budget meeting for 2016 with the credit unions you oversee?
I'm not aware of a board decision on that matter. No.
When would they make a decision on that, Mr. Fazio?
Sometime this year.
Right. Finally, and this sort of may give you some insight as to why I care about this type of thing, it's been a year now since I asked for an answer to that specific question. As to why they didn't do not only the meeting, but why they didn't provide line item information in the budget. Once you actually produce the budget, you don't give the credit unions line item details on your budget. And we asked why you did that and whether or not you would provide to Congress the line items in your budget. That was April 8th of 2014. So I very much would appreciate a follow-up on that sometime soon. Maybe just the next 9 months would be great. But waiting a year for that information, sir, when Congress asks you for what I think everybody would agree is a reasonable request, is probably won't be tolerated very much longer. So I appreciate your looking into that immediately when you get back. Mr. Silberman, we'll move to you now very briefly. I read your testimony. I also heard you say when you came in today a couple of different things, and you use really good language that we would expect you to use, and of course that everybody uses because it's easy to use language. It's harder to follow up. You say that your approach on rules and regulations is tailored and balanced, that you're mindful of the impact of compliance on financial institutions. You engage in rigorous evaluation of the effects of proposed and existing regulations on consumers and financial institutions, and you maintain a steady dialogue with both consumer advocates and industry participants. I think later on you talked about an evidence-based process that you undertake. Again, easy to use the words. Last month we had some folks here on this committee testify to this committee. Dennis Shaw testified to this committee. He's the CEO of the Community Financial Services Association regarding a recent report that y'all just put out on what a lot of people refer to as payday lending. And in that report that you folks created, it estimated that roughly 60 to 70% of small payday lenders would go out of business as a result of your rules and regulations. That didn't seem to be disputed at that hearing. So my question to you, sir, is what evidence-based process did you go through? What balancing did you do? What data do you have that says it's in the best interest of consumers to drive 70% of these players out of the market?
Thank you for the question, Congressman. First, let me begin. The process we've gone through began 3 years ago with a series of field hearings that we've held. We have obtained, I think, the largest data set of loan-leveled, anonymized
Great.
data.
Can I have that, please?
I will have to take that request back. This is supervisory data that we've obtained, so it is confidential.
Why can't Congress have the same data y'all are using for making your decisions?
It is confidential supervisory information, but we'll have to get back to you on that.
Please do. I got news for you. We get confidential briefings all the time. In fact, we have a special room downstairs for it, and to the extent that data on that rises to the same level as the threat of nuclear intervention in Iran, then I can assure you your data will be safe. But please continue.
Okay, and I believe, Congressman, we have actually provided briefings on the data to staff. We've published 2 reports on payday loans, one in 2013 to 2014, based on that data. We've also reviewed all of the research. So we've gone through an extensive process. It is not the case that what we have said is that we have started a rulemaking process. We've announced proposals that we are considering making. We're early in that process. But it's not the case that we've said that that proposal, if it were to become final rule, would put 60 or 75% of payday lenders out of business. That's a misinterpretation of the document that we released.
What is the correct interpretation of that document, Mr. Silberman?
The correct interpretation, Congressman, is what we said is that if the business model continued as is, and payday lenders continue to do exactly what they've been doing, but cap the number of loans they give to people at no more than 6 loans per customer per year, so that's 90 days of indebtedness, that from that line of business, 60% of the revenue would be, they would lose 60% of the revenue, which is to say that 60% of the revenue they're receiving comes from making more than 6 loans to consumers, which is precisely the issue we are trying to get at through this proposal.
Thank you, Mr. Silberman. Thank you, Mr. Chairman, for your accommodation of the extra time, but it may be that we need to have further investigation into that specific matter. Thank you.
The gentleman from Massachusetts, Mr. Capiano, is recognized for 5 minutes. I will mention that votes have been called, and without any I ask unanimous consent that we will, Chair will call for a recess here shortly, and then we will reconvene right after votes. And with that, the gentleman from Massachusetts is recognized for 5 minutes.
Thank you, Mr. Chairman, and I want to thank the panel. I also want to thank my colleagues. I got to tell you, I came to this meeting not sure I was going to stay very long, to be perfectly honest. I thought it was going to be the typical bashing of regulators, and we hate all regulation. This has been great. This is the kind of hearing I love, and I appreciate the Chairman for calling this, and the ranking member, and all the panelists. I've learned a lot. I've listened a lot, and I have to tell you, I get amazed when I agree with pretty much everything that's been said today. That's a pretty good day. Not everything, Nick, but pretty much everything. So I just really, that's where I want to go. I want to associate myself with the comments made by all my colleagues, especially Ms. Maloney relative to the muni bonds. The OCC really has to wake up. Muni bonds are the safest investments in the country, and if banks, any bank, can't invest in them because some regulator says that they don't hit some obscene, obscure, ridiculous little thing, that's nonsense. It is there are some muni bonds that may not meet that safety requirement, but very, very few. Particularly, it's going to hurt municipal governments. It's going to hurt local governments all across this country to tell any bank that they can't invest in the safest thing they can. It is completely wrong. It's completely back-asswards. And I got to tell you, the Fed's kind of moving on it. If the OCC doesn't move on it, you're going to hear a lot more from us relative to that. I don't expect a comment. You guys can look at it all day long.
May I make a comment, though?
You can, but if you come up with the answer that you're not going to do it, you're going to be wrong. But go right ahead.
Well, first of all, we have not prohibited banks from investing in municipal securities.
Well, you haven't prohibited
in
them,
fact,
you've discouraged them significantly.
in fact, sir, the data hasn't shown that. Banks continue
yet.
to invest in municipal
You
securities.
just did it. I mean, you only did it a couple of weeks ago.
And they continue to invest in that and supporting their local communities.
Well, good. If I believe me, I would love to be wrong, and that's okay with me. I also want to move on to some of the risk issues. My big concern when it comes to risk is some of this stuff is so complicated, you end up with a result that even small banks especially can't figure out when they're into a risky situation or not. And as you come up with these data points as to what is and what is not risky, which again, I think the discussion has been great today, exactly where the line is and where it isn't, I think it's really important that you make the calculation of risk easy enough for a relatively small community bank to make the determination that they're getting into an area that's going to require more regulation and more oversight, or to make the decision not to do it. Now, in the past, some regulators have told me, well, we're a little concerned of people gaming the regulations. So what? If they game them to not be regulated, that means they're not doing risky things, which is a good thing. I guess the last thing I want to do is I want to talk about the QM rules. I would argue that the best thing you can do for a community bank, actually I think it fits in the definition I've heard everybody say, is to encourage community banks to actually be involved in the community. You are involved in the community when you have risk involved with the community, namely holding mortgages, holding loans. And I would argue very clearly that as we go on, especially for the CFPB, that QM rules and any other rule not only allows small community banks to hold local paper, but actually rewards them for doing so. I want my local bank, and I'll be honest, I've said it publicly before, all of my cash, which isn't much, but whatever I have, all of my mortgages to the best of my ability are in local banks, because I like the idea they know where my street is. They know where my neighborhood is. They know how much a house is valued. Their kids are likely to go to school with my kids, and on and on and on. But at the same time, if they can't do it, which for all intents and purposes they've been pushed out of it, especially residential mortgages, they can't be a community bank for long. And I would strongly encourage you to not just allow something, but also encourage and reward community banks to actually be involved with the community so that we can have somebody to donate to the local Little League. I don't really have a question, which I said, I didn't really come with questions, but the heck, I had 5 minutes, I figured I'd use it.
I thank the gentleman, and now we will stand in recess until right after votes, and we thank the panel for their indulgence. You know what? Here he is. Perfect. The committee will come back to order, and now recognize the gentleman from Colorado, Mr. Tipton, for 5 minutes.
Thank you, Mr. Chairman. Thank you, panel, for taking the time to be able to be here. Mr. Bland, certainly appreciate your comments in regards to moving that threshold in terms of banks that are in good order and to be able to move that up. Very proud with Ranking Member Clay to be able to put forward some legislation to be able to achieve that. Would actually like to be able to move into some of the small bank issues, and Mr. Bland might want to be able to address this to you first. Every community banker that visits our office right now or testifies before this committee come in and they express concerns about regulations being indiscriminately applied through rule, guidance, or best practice to the entire industry, where in some cases regulation is actually intended for larger institutions. As a regulator, what do you think, do you take into account in determining what is going to be the appropriate regulation to be able to fit the size of a bank?
Representative Timpton, my discussions with bankers, I hear similar issues and concerns that you have raised. And from the OCC, we're very cognizant of that, and we really take an approach that one size does not fit all. And so the approach we take is to look at the activity and whether or not community banks tend to be involved in that. So, for example, we have issued the heightened standards rule that is for our largest institutions. That is not, community banks are not subject to that. The supplementary capital rule was not intended for community banks as well. And so what we take into account when we issue not only rules, but also guidance, we clearly state what is applicable to a community bank and what is not. And then that also translates into our examination processes as well, so that the procedures that drive our supervision of community banks are focused on community banks. So it starts with our ruling, making those determinations. It goes through our examination process.
So trying to be able to tailor regulations to be able to meet it. You know, this brings up a point because I wrote down comments. Ms. Eberly, you had stated keenly aware of regs' impacts on small community banks. Ms. Hunter, you had stated you seek out and are listening to feedback on reducing the impacts of regulations and policies. Mr. Bland, reviewing duplicative review processes. Mr. Silberman, mindful and responsive to the impacts of regulations on financial institutions. And we can go down the line, but the problem is this. We are continuing to see rules and regulations that are literally crushing the industry. I come from a small rural community, Southwest Colorado. Just recently visited a community bank in Delta, Colorado, and they said they're about ready to give up. That they're no longer doing the banking business. They're complying with rules and regulations, and the costs are enormous. When we go back to Mr. Ginta's comments, the bank in his state, 22% in terms of the cost. So I guess my question is there any collaboration in terms of trying to be able to streamline, because we're talking about duplicative regulations. When I listened to the comments, I heard you saying the things I would love to be able to hear. But are we seeing this actually happen in practice? Because our institutions continue to see those costs go up. Ms. Eberly, you had cited the stress test. We have Zions Bank, which is basically a collection of community banks, but a regional bank. Their stress test paperwork last year was 7,000 pages. This year was 12,000 pages. How's that paperwork reduction working out?
The stress tests are one area where we didn't have a lot of discretion in the rule writing process because of what was in the statute, and we would welcome more discretion. We've been able to use discretion, for example, in the enhanced prudential standards and the way we look at resolution planning. So we have tailored resolution plans for the smaller institutions versus the larger and more significant expectations for the systemically important financial institutions. But on stress tests, one of the important things I'd tell you there is that when we issued the guidance, we issued it jointly. And we put a statement together that we attached to it that said it did not apply to institutions under $10 billion. And we've continued to do that and put statements of applicability on every financial institution letter that we issuing a rule.
And I appreciate that. And given the concern that you have all expressed in terms of the impacts, particularly on community banks, do you find it of great concern that apparently only 60% of the Dodd-Frank rules are written and 40% are yet to come? Do we continue to see more piling on? Ms. Center? Feel free. You look like you want to.
Well, I was looking, we were over time, so that's why I was. No, there are still rules to be written, but the vast majority of the rules that are in process really relate to firms over $50 billion in assets. So that I would not anticipate that they would affect community banks in any material way.
Okay. I yield back, Mr. Chairman. Thank you.
Chair now recognizes the gentleman from Washington, Mr. Heck, for 5 minutes.
Thank you, Mr. Chairman, very much. Mr. Silberman, this is for you. I've been enormously privileged in my life to sit on both sides of this table. I'm a former chief of staff to a governor, and agency directors were direct reports to me, so I've had to supervise, monitor the development of rules and regulations and their implementation. But of course, I sit here now, and I'm also a former state legislator, so I also know the world of proposing policy that then has to be implemented through the promulgation of rules and regs, and I know the world of hearing back from people who are affected by those policies and implementing rules and regs. And I've come away with a kind of a lifelong point of view that what all of this is about is the very difficult and creative tension between clarity and flexibility, which are at odds so very often, right? Clarity, which we are asked for all the time. Just tell us what the rules are, which leads to bright lines. But at the same time, we all together often hear, where's the flexibility? Why can't this be more discreet as it relates to our personal circumstance? So you got this ongoing clarity versus flexibility tension in your world, and I think they're both equally important and valid. And by analogy, eventually I'm going to get to my question, I assure you. There needs to be this magic balance between the inputs on the development of policy, anecdotes and data. They're both valuable. I wouldn't want to try to develop policy at this level based purely on anecdotes, but I value them because they put a human face and a story to it. Nor would I want to be robotically tethered to data. As it relates to QM, and you knew I would get to a question eventually, we're hearing a lot of anecdotes about how the QM rule is impacting financial institutions. And I think it's important to listen to those. Again, I don't think it ought to exclusively or purely drive our response, but it is important. My question, sir, is where's the best place to go to get the data? If there is an implementation issue out here that is causing problems, which we are given anecdotal evidence of, where's the best place to look at the data to help give context to those anecdotes?
Well, thank you, Congressman. It's a great question. And I think when it comes to QM and the mortgage market, there are multiple sources of data to be used, as well as you say, listening to the real stories and the voices. So HMDA is certainly a key source of data, which provides insight into the number of loans by size, and all that. So we will get information from HMDA. The call reports is another source.
The which?
The call reports,
yes.
Banks and credit unions all file as a second source of data, some data. And as you may know, we have been working with the FHFA to create a national mortgage database, which would enable the first time to have a representative sample of all mortgages de-identified, and that will, when it's up and running, provide probably the best source of data, but we can't wait for that to be able to make calls.
I have another quick question, probably don't have time for it. We've tried very hard to provide carve-outs or exemptions to smaller institutions in recognition that some of these things might not, again, best suit the purpose of the smaller institutions. What we're hearing, however, is that there is evolving a pressure toward best practices which come from, quote, above the larger standards, rules, regulations. It's hard for me to ferret out exactly the origin of this. Is it this is not for you, Mr. Silberman. I apologize. This is for Ms. Eberly and Mr. Fazio. Is this pressure, in your opinion, coming from examiners, from the consultants? I'd like a brief, because I have limited time, sense of, do you think that there is this kind of amorphous pressure that even though we grant carve-outs, for which we think are very valid reasons, nonetheless kind of the cultural milieu and context mitigates against the very thing we're trying to accomplish in that regard? Ms. Eberly, Mr. Fazio, I'm sorry. Pardon?
In writing to the gentleman, we're trying to get through. We've got some folks who need to catch some airplanes.
I apologize, Mr. Chairman.
But it's a good question, and the witnesses will please respond to that, too. Now recognize the gentleman from Texas, Mr. Williams.
Thank you, Mr. Chairman. I want to direct my questions to Commissioner Cooper and Mr. Silberman. My first question is to Commissioner Cooper. In your testimony, you spoke about the need for legislation to support NMLS's ability to process background checks. Regulatory efficiency is important for regulators and regulated entities. I personally understand this, being a small business owner. Access to credible information is everything. So my question, Commissioner, is how will legislation you are working on with Congress promote this type of efficiency?
Thank you, Congressman. First, let me say since 2010, the NMLS that we discussed earlier have been processing background checks, and they've been doing it very efficiently on the mortgage loan side. What we want to make sure is a SAFE Act that allows us to be able to use the same efficiency and use that on our other non-bank industries that we regulate, such as in Texas, we regulate money service businesses. It takes approximately 2 days to possibly 2 weeks to get background checks. The NMLS system can do it in 24 hours, so we'd like that efficiency.
Okay, thank you. And one other quick question. Your definition of a community bank.
Congressman, if I could, everybody here has been talking about what the pieces are for a community bank, and I agree with most of it. What I think we've got here, for instance, the FDIC definition that they use for data brings in about 6,000 banks. Vice Chairman Honig's definition that was mentioned earlier brings in about the same amount, less about 148. My point is that we're so close in being able to come up with a definition that I would suggest that we would be able to get together and come up with these things. And we do have to have what I call a determinator, somebody that can decide on the differences, and that would be, our recommendation would be the chartering agency.
Okay, thank you. Mr. Silberman, in full disclosure, I need to tell you that I'm two things in this world. I'm a car dealer, and I'm a community bank shareholder. Now, the CFPB issued its guidance on indirect lending on March 31st, 2013. And I think we need to be honest. This guidance was meant to intimidate indirect lenders and eliminating payments to car dealers whose customers have auto loans with higher interest rates. Would you agree with that, yes or no? Simple answer.
No.
Okay. Now, I know that the CFPB thinks that these payments lead to discrimination. And I can understand that back in March of 2013, your lawyers were too busy to go through the rulemaking process, so they took a shortcut. But now more than 2 years have gone by since you issued the guidance, and as far as I can tell, you haven't made any effort to do what the law requires. Now, if you want to create a rule that businesses have to follow, so my real question is this. First of all, what's the problem? And why aren't you even trying to do this the right way?
So, Congressman, thank you for the question. The problem that we've been addressing is that indirect auto lenders are engaged in practices that are producing disparities.
No, you don't know that.
We have found that through our supervisory work, through our investigative work.
All right. Next question. Are you afraid that your statistics won't look so good by hiding this information?
I'm not sure what information you're talking about that we were hiding, Congressman.
Well, you're not rulemaking. You're intimidating.
Oh, I respectfully disagree. We are not intimidating. We are not rulemaking because we have not made any rules. We have simply, what the bulletin simply announces is what has been well-established law for a long time in terms of the obligations of an indirect auto lender under the Equal Credit Opportunity Act. We thought it was useful and important for us to put the banks that we examine on notice of our understanding of the law, and it is well-settled law. So there was not a rule to issue because there was no change in law.
Do you worry that the cost of compliance on small businesses and regulations could cost small businesses profits and even put them out of business? Do you worry about that?
We are certainly required by statute, and we think about the access, the intent.
But are you worried about that? You think it might put a long-time business out of business because of the cost of meeting these regulations?
We are always concerned about access to credit for small businesses as well as for consumers.
And what do you say when somebody says they're having to hire more compliance officers and loan officers in these banks?
Congressman, I think what we say is that we want to understand that. We want to make these rules as easy as possible to implement, that we've engaged in an extensive effort to try and assist and make it so that they don't have to lawyer up to implement the rules and to adjust the rules so that we don't have a one-size-fits-all approach.
Appreciate
Time of the gentleman has expired. I thank the gentleman. And now the gentleman from Georgia, Mr. Westmoreland, is recognized for 5 minutes.
Thank you, Mr. Chairman. Yesterday, Congresswoman Maloney and I reintroduced the Financial Institutions Examination Fairness and Reform Act. I am very excited to be working with Ms. Mahoney as she and I have worked together, and she has worked tirelessly to help the community banks. To me, this bill addresses the major concerns my community banks have had with the regulators during the financial crisis. The core purpose of this bill is to provide financial institutions a way to appeal examination determinations to a neutral and independent third party. This independent examination review director is tasked with determining whether examiners have fairly and accurately applied rules and guidance from the regulators. All too often, I have heard that banks in my community have nowhere to turn when an examiner makes a mistake or is applying rules unjustly. I would like for each of the Federal supervisors just to go down, simple yes or no answer. Will you support or remain neutral on this bill? Just a simple yes or no.
No, sir.
Our agency doesn't have a position on it, so I'm not in a position to say we'd support or not.
Representative Westmoreland, we don't support it, no.
We have concerns with various aspects of the examination fairness bill.
Mr. Stillman, do you have anything to say? Do you know anything about it?
No, sir.
All right, good. Ms. Eberly, you brought up a point about when my colleague from Georgia, Mr. Scott, and I, who have been working tirelessly on our failure of community banks, mentioned the acquisition, development, and construction loans. It brings up why I think this bill that we have is so important, because it talks about non-accrual and placing loans in non-accrual. I was in the building business. I was in the development business. I was in the real estate business. I know for a fact of some of these loans that were current, they have been going by and abiding by all the terms of the loan, but they were forced to be put into non-accrual, which took the cash position of these banks down. Now, what is wrong with a small community bank being able to say, look, I know this guy, he's paid his loans, he's had his loans. Why does he have to go into the non-accrual status?
After the crisis of the late 80s and early 90s, Congress passed a law indicating that the financial institution regulators had to require institutions to follow GAAP, generally accepted accounting principles. So we don't have that flexibility. And
that's why we're trying to change the law.
Right.
But you don't want us to change the law.
Well, a couple of problems with the idea of a ombudsman that would overturn agency findings without having accountability for the supervision of an institution.
So basically, the government agencies think you know more about a bank's borrowers than what they do. Is that correct?
No, sir. We require institutions to follow GAAP.
Okay.
And if they weren't following GAAP, they'd essentially have two sets of books. So
Okay.
one set of books where they
Well, thank
reflected
you.
it that way, and one for the regulators.
And I'm sorry y'all opposed the bill. Also wanted to talk about the Economic Growth and Regulatory Paperwork Reduction Act. In the past 15 years, there's been 801 regulatory rules that have gone in to these banks. My concern is the volume and the complexity of these banking regulations is going to put more of our community banks out of business. And since Dodd-Frank, my understanding is that those rules will not be included in this next review. And so it will be, I think, 2026 before these Dodd-Frank's rules will be considered under this rule. Can you tell me why Dodd-Frank rules aren't being considered in this next review? And can anybody tell me, after 801 regulations, can you tell me how many has been, because this was only up to 2006, how many have been after 2006, and what paperwork has been reduced or what rules have been removed?
Representative Westler, and I'll take the first part.
Sure.
And we had issued, the regulatory agencies had issued a letter that indicates that we will include all regulations that have been implemented in the AGRIPA process going forward. So, starting with our next hearing in Boston in May, but also the public comment period. So we did decide to include all rules. So that would include the Dodd-Frank rules that have been implemented would be part of the AGRIPA process.
The time of the gentleman has expired, but I would ask the other witnesses to respond to the gentleman's question as well. Now go to the gentleman from Kentucky, Mr. Barr, for 5 minutes.
Thank you, Mr. Chairman. Ms. Eberly, in February, you testified before the Senate Banking Committee, and I believe your testimony was to the effect that traditional banks were able to weather the financial crisis reasonably well and are continuing to perform well. But as has been discussed here today, since 2010, when there were about 7,657 banks in the United States, 4 years later, by the end of 2014, that number had declined to 6,509 banks. At the same time, since the enactment of the Dodd-Frank Act, banks with less than $10 billion in assets have seen their market share decline by 12%, double the 6% decline of the four pre-Dodd-Frank years. So again, to Ms. Eberly, referencing back to your February testimony in front of the Senate Banking Committee when Senator Heller asked whether you thought industry consolidation was a concern, your response, I believe, was that most consolidation results from a financial crisis, so the way to prevent consolidation is to avoid crises through more regulation. My question is to you, one of the goals of financial reform was to solve this problem of too big to fail. And yet what we've seen is an avalanche of red tape coming in response to the financial crisis and a contraction of banks, a contraction of competition and choice, a consolidation of assets, and a concentration in fewer banks and bigger banks. So my question to you is, do you still maintain that more regulation is needed, or do you recognize that some of the avalanche of regulations is actually counterproductive from a standpoint of diminishing competition and exacerbating the problem of too big to fail?
I believe in that hearing I was referencing our study on consolidation, which showed that about 20% of the consolidation that had occurred over the last 30 years was attributed to two big crises, with failures from the crises. And so what's in our control is to have good supervision, not regulation, but supervision, to ensure that banks don't fail, so that we have good balanced supervision in good times and we don't go too far in bad times. So that's, I think, very important. And
fair enough, and I'm all for supervision and making sure that we don't have a financial collapse. But to kind of follow up Mr. Ginta's line of questioning, where he was referencing only 5 new charters in the last number of years, I think Senator Shelby referenced only 2 de novo bank charters had been granted since the financial crisis. My question, really, following up your testimony in the Senate, is: do we really believe that it's a 6-year economic cycle that's to blame here, or can we acknowledge that at least some of the reason for the consolidation, some of the reason for the lack of new charters is over-regulation?
certainly the costs of operating in a regulated environment are factored in, but we've seen a tremendous amount of money come into community banks in the form of investment in that same time frame, which suggests to me that community banks are still viewed as viable by the investing community, and that the cost of regulation isn't keeping them from coming in.
Well, let me just share a little anecdotal feedback from some of the community banks, small community banks in eastern Kentucky or central and eastern Kentucky, where I represent, and what they and I think they would be disappointed to hear that you all are opposed to basically fair exam procedures where you have an independent appeal process. I mean, basically what a lot of these bankers are telling me is that they're no longer in the business of lending. They're in the business of paperwork and compliance. And for every $100,000 that they have to put into compliance, that's $1 million less capital deployed in their communities. So I would hope that there would be some sensitivity to that. Let me move on, since I'm running out of time, just really quickly to Commissioner Cooper. You mentioned in your written testimony that you support granting QM status to loans held on portfolio by a community bank. I have a bill called the Portfolio Lending and Mortgage Access Act. Mr. Silberman, your agency opposes that legislation. Director Cordray is on record as opposing the legislation. My question to you, Commissioner Cooper, can you explain your thinking and why you disagree with Director Cordray? Why is it that as the top representative of state-based regulators that you believe that portfolio lending encourages an alignment of interest between the lender and the borrower that would actually prevent some of the practices, the originate-to-distribute practices that led to the financial crisis?
Well, Congressman Barr, you said it very well. The community bank model does align the risk of the entity with the benefits of the consumer, and so we believe, the CSBS believe, and state regulators believe that community banks holding mortgage in portfolio should be exempt, because it also has created a problem that we believe by survey that it is declining, and if we don't reverse this decline, we'll continue to have obviously further decline.
Thank you, gentlemen.
Thank you.
The gentlewoman from Utah, Ms. Love, is recognized for 5 minutes.
Thank you. I just want to get right into it. Just to be clear, Mr. Silberman, do any states lack the authority to implement ability to repay and roll over limits for state licensed payday lenders?
Thank you, Congresswoman.
I'm sorry, I can't see you. Okay, there you are. Thank you.
Sorry. So we have been thinking about, our job is to assure that consumers have the rights and protections that they're given by federal law, and that's the question we've been asking, rather than the question of what states can or cannot do.
Well, we should be asking what states can or cannot do, because, I mean, if you think about it, Mr. Cooper asked, can you describe the authority that states have to regulate these products? The answer was, we have not thought about the state's ability to regulate. We feel like it's our job, something like our job, to regulate these and try and figure out how we're going to protect consumers. Is that your assessment?
It is our assessment that it's our job to assure that consumers have the rights that is provided to them under federal law.
Have you identified any states that have failed to adequately protect its citizens?
As I say, our job is
have you identified any states that have inadequately protected its citizens when it comes to these?
As I've indicated, Congresswoman, that's not the question we're charged to ask, and that's not the question we've been asking.
Okay, so from what I can see here, if we already have states, by the way, 2 states have done away with these products, and you can't identify or are not willing to identify states that have failed to adequately protect its citizens, it seems to me that the job is pretty much to protect your job if you're duplicating or stumping what states are trying to do.
Our job is to assure that consumers are not subject to unfair, deceptive, or abusive acts or practices that they get the disclosures that Federal law requires, that they get the protections
So your job is to stump states then, when it comes to these products? Because seriously, why do you think the national solution should be to trump the states? If the states are already regulating these products adequately, why do you feel like you need to replicate or trump what they're already doing? I live in a state that does very well. As a matter of fact, these products we have not had any problems with these products. Our citizens love them. They think it's another option for them. And so now, here I am, the House of Representatives, which is the branch of government that's closest to people, by the way. I'm having to listen to you say, well, our job is to pretty much figure everything out for the states. What's the point in having states regulate these products?
So, first, to be clear, I did not mean to say, if I said I apologize, that our job is to trump the states. Our job, Federal law would not trump the states. It would establish a floor, which is, in a Federal system, the way things work. Just as the states, there is a Truth in Lending Act, and the states can add protections on top of that. There's a Truth in Savings Act, and the states can add additional protections. There's a Fair Credit Reporting Act. That is the job that Congress has given us and that we are intent on doing.
Okay. Well, it doesn't make any sense to me if states are doing it and you can't identify a state that is inadequately protecting its citizens. It seems to me if you're going to do what states are already doing, it's like I'm just here to maintain my job. I need to do something, so I'm going to do something that states are already doing. It makes absolutely no sense. I'm going to shift over and just talk to Ms. Hunter about the Volcker Rule. As the Volcker Rule is being implemented, we're learning more and more about unintended consequences with the rule. One that has come up that has to do with non-financial companies that own depositories, such as ILCs or unitary thrifts. As the Volcker provision is drafted, if a non-financial company owns a depository, the Volcker requirements apply to all of their operation, even those that are not engaged in any financial services, which means that non-financial companies' ability to carry out some basic risk management could be seriously impacted or harmed. So the question that I have is, do you believe that the intent of the Volcker provision was applied to the non-financial affiliates in the industrial company that owns a depository?
Well, I certainly understand the concern that you're raising, and the issue is really created in the Dodd-Frank Act itself, in that you're corrected when you say that it really applies the restrictions on proprietary trading and the investments in and relationships with covered funds. Under the Volcker Rule, it applies those to insured depositories and their affiliates.
But do you think that this is one of the unintended consequences? Because we're impacting industries that are not in financial services. And I just want, if it's okay, on the record, I'd love to have a comment on that in terms of a well-thought-out comment, as if you believe that this was an intended consequence.
If you would furnish Ms. Love a written response on that, we'd appreciate it.
We'd be happy to provide some information, yes.
Thank you. And now the gentleman from California, Mr. Sherman, is recognized for 5 minutes.
Thank you. Mr. Silberman, my colleagues have heard me talk about the new TILA RESPA forms. You're certainly aware that the real estate industry and the real estate closing industry is focused on this. One would expect some bumps in the road once these rules become effective. Have you explored the idea of a reduction for a few months or suspension of the penalties for the innocent errors that are likely to be made in the first few months of operation?
Well, thank you, Congressman. The TILA RESPA rules, the know before you owe rules, as we think about them, as you know, were issued in November of 2013. We did provide for a very long implementation period in order to assure that they could be effectively implemented. We've been working diligently with the industry to assure that it can get implemented effectively. I believe this Director Cordray spoke to this issue when he was before the full committee last month and has some recent correspondence. And I think what he said is that we are focused right now on assuring a successful achievement of the effective date, but that we always and continue to listen to people's ideas about around that?
Well, I hope you'll listen to the idea that, yeah, you have an effective date, but it ought to be a soft date when it comes to be either imposing governmental penalties or opening the door to civil lawsuits, because until you take it on a shakedown cruise, you don't know which part needs to be fixed. Mr. Fazio had this great question about the need for supplemental capital, but somebody else already asked a similar question. So instead, we'll talk to you about how NCUA has not shown any instance where the lack of enforcement authority over credit union service organizations has been a material issue. Is it correct that NCUA already has authority via the credit unions they regulate to review and dictate enforcement with regard to credit union service organizations, which insiders call QSO? I was told to mention that to show that I really knew the industry. It's my understanding that non-QSO vendors are already subject to reporting and reviewed through the Federal Financial Institution Examination Council. With the tight budgets that everyone in government faces, do you really need to get involved in this in a new way?
So thank you for that question, Congressman. Two aspects to that. I'll take the latter first. The non-QSO vendors, third-party vendors that are not a credit union service organization, if they do business with banks, then they would be subject to oversight by the other FFIC agencies. However, we have several vendors that are large that only serve credit unions as clients, and they're not QSOs, and so they're not subject to regulatory oversight. There's a blind spot there, and we've in fact had problems with a few of those historically. In terms of QSOs, in particular, to the former part of your question. We have had, in fact, some problems with QSOs. We have an indirect authority over QSOs. We have a regulation that requires credit unions that do business with QSOs or that own a QSO to require certain things contractually, like access to books and records, that they follow generally accepted accounting principles in preparing their financial statements and so forth. However, it's a very indirect authority in that sense. We don't have insight into the full landscape of the credit union service organizations. And our limit to their books, and we have limits in how we can access and examine them in terms of understanding their business models. We've seen problems historically in QSOs, and I would say that QSOs are a great opportunity for especially smaller credit unions to collaborate. We support that, achieve economies of scale, and do things they might not be able to do otherwise independently. But it also creates a gap in our ability to understand the nature of the risks to those credit unions. In some cases, dozens.
I'd ask you at least not to duplicate the efforts of the Federal Financial Institutions Examination Council,
we would have no intent of doing so. We cooperate and collaborate with them closely.
I've got 14 seconds, so I'll just point out that the gentleman from Florida, Mr. Posey, and I have a great bill that perhaps if the FDIC would focus on it, you could solve it at your level. You've got bank holding companies where you would not have an invasion of the assets of the insurance company that they might hold. Should there be a liquidation, you need to do the same for thrift holding companies because we've got a state system of regulating insurance companies, and the assets of the insurance company need to be there to protect the policyholder and shouldn't be rated by the FDIC for other purposes. I'll yield back.
I thank the gentleman, and now the gentleman from Pennsylvania, Mr. Rothfuss, is recognized for 5 minutes.
Thank you, Mr. Chairman. I thank the panel for spending some time with us today and appreciate your patience through the vote break. Mr. Bland, I want to address a question to you. As you know, mutually chartered financial institutions have a long history in the United States of serving their local communities and promoting Main Street economic growth. Their structure grants them flexibility to take a long-term outlook rather than focusing on quarterly earnings. But it comes with a unique challenge as well. For example, mutual banks are constrained in their ability to pursue activities that best suit the needs of their communities by restrictions set out in the Homeowners Loan Act. The only option is to go through the time and expense of converting to a national bank charter, which is a particularly burdensome process for smaller mutual institutions, as they must first convert to stock form before they can convert their charter. To address this issue, Representative Himes from Connecticut and I have introduced bipartisan legislation, H.R. 1660, the Federal Savings Association Charter Flexibility Act, which provides all Federal Savings Associations, including mutual banks, with the option of offering a broader range of services similar to a national bank without the burdens associated with changing charters. This legislation establishes a simple election process for an institution to become a newly created covered savings association, and it includes important safeguards to prevent fire sales of assets and subsidiaries during the transition process, while also preserving the ability of the OCC to enforce the law and prevent evasion. I know this issue is near and dear to the Comptroller, so I would like to ask you, is the OCC supportive of the reforms in H.R. 1660?
Representative Rothfuss, as I said in my oral remarks in our testimony, very appreciative of you and others for supporting this bill. And as you indicate, the Comptroller is very sensitive and supportive of giving flexibility to the thrift industry. The Federal Savings Association.
Would you agree that these institutions need and deserve more flexibility?
Yes, yes, they do. As originally structured, they were primarily driven to the mortgage space in terms of providing those services. But there are a lot of other entities that are involved in that, but they're still constrained by laws that limit the types of loans that they can do. And in fact, they have a lot of experience in making consumer and commercial loans, but they do have a limit in which they can do that. So the ability for them to continue their governance as a thrift, but to exercise the flexibility that other institutions have in terms of what the right business model, we're very supportive of that.
Thank you. Ms. Eberly, I wanted to read something that I've received from one of my local community banks. 2 years ago, we, the bank, decided to appeal a matter for which an appeal process was applicable. When an on-site examiner communicated to the regional office that the bank was taking this action, a regional officer of the regulator responsible arranged a phone call with the bank and its legal counsel. The regional officer conceded during this call that the bank had the right to appeal the matter, but strongly suggested that the bank not do so. He informed us that he had already spoken to the so-called independent reviewers and that we would lose that appeal. I don't know about you, but I find this story pretty troubling in terms of the effectiveness and independence of the processes that currently exist for institutions to appeal material supervisory determinations. I think it also raises some due process issues. Worse still, it's not an isolated incident, and it's illustrative of many complaints that the committee has heard. So I'd like to get your response. In light of this example, wouldn't you agree that reforms to the examination process are warranted?
So the situation you described would not at all be consistent with our process, and I would very much appreciate having the information and be able to reach out to the institution. Our process is that we do encourage institutions to try to resolve concerns at the lowest level possible.
But if this happened, wouldn't you agree that reforms
it would be inconsistent with our policies. We do have an independent review process that starts with the regional office. It next comes to me. I'm a 28-year examiner. A group that's independent of the oversight of the region reviews all of the materials from the institution and from the FDIC, our reports of examination. They make a recommendation to me, but I make my own decision. And if an institution doesn't agree with the decision that I make, they may appeal to our Supervisory Appeals Review Committee, which is an independent organization headed by an independent
we'd like to follow up with you on that.
I'd be happy to.
I've also been increasingly concerned about consolidation in the community banking and credit union industry. As you may know, a recent study by researchers at Harvard's Kennedy School of Government found that this sort of consolidation is in fact occurring and that the Dodd-Frank Act has accelerated the trend considerably. In a hearing before the Senate Banking Committee on February 12th, you argued that the lack of new bank entries is due to the economic cycle versus one of the legislative barriers or even regulatory barriers. In light of the Harvard study, do you still stand by those remarks?
I would have to point out a couple of things about the Harvard study. Number one, the market share definition was based on total assets, and we've spent a lot of time talking today about the importance of community banks lending in their communities. If you actually look at market share of loans, community banks' market share declined in the 20 years leading up to the crisis, but since the crisis, it's stayed stable, and actually it's increased about 0.1%. So a 20-year decline has stopped after the crisis.
I yield back. Thank you.
Thank the gentleman. And now the gentleman from Wisconsin, the chairman of the Oversight Investigation Committee, Mr. Duffy, is recognized for 5 minutes.
Thank you, Mr. Chairman. Ms. Eberly, you're part of the senior management of the FDIC, is that correct?
Yes.
And do you report directly to Chairman Gruenberg?
Yes, I do.
When Chairman Gruenberg gives you a directive, do you follow it?
Yes, I do.
In your experience, you've been at the FDIC for some time and part of the senior management team. When Chairman Gruenberg gives a directive, does senior management follow that directive?
Yes.
Okay. And so I want to talk to you about the FIL, the financial institution letter that came out in January of this year.
Mm-hmm.
Did you participate in the writing of that?
Yes, I did.
And what I think is an important part is that you've encouraged institutions to, quote, take a risk-based approach in assessing individual customers' relationship rather than declining to provide banking services to an entire category of customers. It's very important. Were banks stopping business with a whole line of customers in your experience in the risk-based work you've done?
We've heard a fair amount of anecdotal evidence to that. In fact, a group of pawnbrokers represented by the National Pawnbrokers Association came in and met with us and gave us a spreadsheet of customers that had lost their accounts.
Do you think that the decisions that were made by banks had anything to do with the regulation that came from the FDIC?
In that particular case, they gave us a list of 49 institutions, only one of which was supervised by the FDIC, and that institution's decision appeared to be a risk-based decision based on the reason that they had provided to the customer.
So based on your work, have you seen any evidence that the FDIC has a list of prohibited businesses that they send out to banks?
The FDIC does not have a list of prohibited businesses.
Now, are the regional directors part of the senior management team?
Yes, they are.
And they're the ones that also follow the directive of Chairman Gruenberg?
They report to me.
They report to you?
Mm-hmm.
So if there's a consent decree or a memo of understanding that's sent out, do you see those?
It would depend on the level. Much of our enforcement action is delegated.
Okay. Do you see those?
I see some.
But not all?
No, not all.
Would you be surprised that there are memos of understanding or consent decrees that go out with prohibited products?
I would be very surprised, and I would want to see them.
Well, there was an investigation that was done by the Oversight Committee. We received documents from the FDIC. They did a report. I know Chairman Gruenberg has seen it. I'm sure you've probably seen that report. And the documents are referenced, and I have them in my hand. I have one while you were the Director of Risk Management. These folks report to you. Anthony Lowe from Chicago. Prohibited acts. And by the way, the definition of prohibit per dictionary.com is to forbid. Payday lenders. Would that surprise you?
So you mentioned consent orders and memorandums of understanding, and so I'm familiar with the information that we provided to the committee.
Are you surprised by this?
None of those had any language that said there's no MOUs or consent orders turned over to the committee that would have any language that says that. There shouldn't be any that would say that.
So I've got one from 2013.
So I would want to see the document that you have.
Prohibited businesses.
Can I see the document?
Firearm sales. Could we take a recess, Mr. Chairman? I'll show her the documents. Well, I can circle back. So are you saying that?
I'd like to see the document.
But you'd be surprised by this?
I would be very surprised.
Would this be outside their lane in the directive that was given by you and Chairman Gruenberg?
To include prohibited businesses in a consent order or an MOU?
Yes.
It would be to say prohibited. Now, there are consent orders where we've told institutions they need to exit a line of business because they weren't managing it properly.
So, but the list that I see look pretty similar to the high-risk list that was issued in 2011.
No, that would not be consistent with policy.
Okay.
So I would need to see what you have.
So if these are being issued, we have rogue individuals operating inside the FDIC, right? I mean, because obviously you wouldn't give the directive, and your testimony as Chairman Gruenberg wouldn't give the directive. These are rogue folks, right?
There are no consent orders or MOUs that contain that kind of information, to my knowledge.
And you are certain of this?
I said to my knowledge, there are none. I would like to see the document that you're holding.
And have you reviewed a lot of, as you know, there's an investigation going on. Have you reviewed?
Yes, sir.
And you haven't seen any?
I have not, sir. I would like to see the document that you're reviewing.
Okay, and I'll provide them after, but these were documents that were given to our committee from the FDIC that were referenced in the report. I guess my time has expired. I yield back.
Without objection, we're going to have a quick second round, and I'm going to recognize the gentleman from Georgia, Mr. Westmoreland, for a quick 5 minutes.
A quick 5 minutes. First of all, I want to thank all the witnesses for your patience and sticking around. Ms. Eberly, I'm sure that when y'all did your report on what the main cause of all the bank failures that we have, did you find that the non-accrual was one of the main reasons for some of these bank failures, or was there another thing that led to the bank failures?
Our Inspector General has conducted a material loss review on most of the failures, and they are required by statute, as you know, for ones that exceed a certain threshold. And they've done a couple of overview reports. And the commonalities between the institutions that failed were that they had heavy concentrations of credit, they grew rapidly, and they funded that growth with brokered deposits. So those are the three characteristics of the institutions that failed.
But being the director of the risk management at the FDIC, did you do your own study of what may have caused these?
I've certainly participated in the material loss review discussions with
but
our
you didn't
Inspector
find you
General.
didn't find the non-accrual regulation had anything to do with these failures?
No, sir. So non-accrual is an accounting determination of whether or not you're recognizing income on a cash basis, or I'm sorry, on your accrual basis on your balance sheet. If you're still getting paid on a cash basis, there's money coming in, and so that wouldn't cause a failure. But if it's non-accrual because a customer is not paying and you're not getting the repayment on the loan, that will contribute to a failure. It will contribute to problem loans.
Okay. So you don't think the non-accrual aspect of a bank that had to put current loans in that category had anything to do with it?
I believe our IG studied that and has provided the answer that was requested.
Well, could you just share it with me right now?
I do not, and that was their conclusion as well.
Okay. Now, you mentioned, and Mr. Bland and Mr. Fazio, that you were opposed to the bill that Ms. Maloney and I have dropped. How do you make that opposition known?
So I'm not sure of the question. You asked a question, and you had described.
Did you support or not support?
Right, and you described.
And you said no.
You described the two provisions. So the ombudsman to overturn regulatory findings, and also the not having to put loans on non-accrual.
So you don't think?
So those are two things that give us great concern as a regulator.
I know, but I mean, how would you go about making your opposition to it known? Would you go into members' offices? Would you send a letter out? I mean, how do you make your opposition known? Or do you just oppose and don't say anything?
No, sir. We answer your questions when you ask, and we will share our concerns. We're happy to try to work with you.
No, I know, but do you share that with members of Congress? Do you call them, go into their office?
I do not personally, no.
Well, does anybody that works for you do that?
No.
We've had Representative Westmoreland a lot of discussions with members of Congress and their staffs around this issue with respect to the timeframes for exams, around the ombudsman, and our concerns about the non-accrual. And so we would engage members of Congress in this discussions around where.
Would you consider that a lobbying effort?
No, we consider it being responsive to the question, like you asked today, of whether or not we support it, and we express our concerns about what we think might be the unintended consequences of the law. So we engage in that discussion.
Well, I appreciate you looking at unintended consequences, because the administration has certainly caused a bunch of them. Mr. Fazio, how about you? How do you get your concerns out?
Similar to what Mr. Bland indicated, we have conversations with committee staff or your staff members, and in fact, oftentimes the staff reaches out. The staff reaches out to us for our input to try to identify unintended consequences or issues that the bill would create.
Okay. Well, do you all? And I'm assuming that you don't agree with everything that comes out of Congress. And we certainly don't agree with all your regulations. So I think it will be a fair fight. But again, thank you all for your patience, and I yield back.
I thank the gentleman, and I know the panel will be glad to hear this. This will be the last question. panel. And the gentleman from Kentucky, Mr. Barr, is recognized for 5 minutes.
Thank you, Mr. Chairman. Thanks for the excellent hearing, and thanks to all the panelists, and thanks for your patience as this is going to be the last round of questioning. I do want to just follow up a little bit, Ms. Eberly, with the comments and the feedback I'm getting from these community banks supervised by the FDIC. And one of the common themes, in addition just to the compliance costs and the intrusiveness of some of the exams in terms of taking personnel off of the actual business of banking, which is lending, is the idea among particularly small, non-systemically important institutions in rural Kentucky that there is a trickle-down effect. There's a trickle-down effect with these regulations where regulations that were maybe originally intended for large, systemically important are being applied to smaller banks, often in the form of the examination process, where examiners are coming into the small bank, identifying those regulations as best practices, even regulations that specifically don't apply to the smaller institution. And yet, because these are quote-unquote best practices, these small institutions with small compliance staff are being asked to nonetheless comply with the larger standards. Can you comment on that?
Certainly, that would not be consistent with our policy. So,
yeah, I know it's, and that's been your testimony all day today. It's not consistent with your policy. I heard that with respect to Congressman Rothfuss's example as well. It's not consistent, and yet we're hearing from our regulated constituent banks that that is in fact happening.
I would ask you to ask them to contact me.
Okay, and here's and that response I heard as well. And just forgive me for my frustration, and I'm sorry I appear frustrated, but here's the problem. What they tell me is they don't want to be identified. They don't want to be identified because they feel it's intimidating. And so when I say I am disappointed that you all don't want maybe even a version of the Westmoreland bill that is a fair exam reform bill that would provide for independent review of your exams, the reason why that's necessary is because our institutions don't want to be identified, because they fear retaliation, because there's not an independent review of your exams. So do you have any sympathy for that concern, that if we do identify our banks to you, these banks who have concerns, that you will take a retaliatory approach and there is no legitimate objective appeal, it's just a rubber stamp affirmation of the previous review by your examiner?
So examination findings have been overturned where they're incorrect. We absolutely do that in the appeals process.
How often is that?
It's not frequent. There's not a lot of appeals that come forward in the formal process. Issues are generally resolved at the lowest level.
Well, let me give.
But we really guard against the idea of the trickle down with statements of applicability on all of our financial institution letters as to whether applicable to banks under $1 billion. There's a review process for every report of exam to make sure that it is consistent with our policy. So if that is happening, it's very troubling to me, and I really would want to talk to the institutions. It would be very helpful.
Well, we'll continue to work on that. And I want to give the regulators, the OCC, Fed, FDIC, some credit, because I heard in your testimony that you were interested in a longer examination cycle for highly rated community banks. I have that provision in legislation I've introduced called the American Jobs and Community Revitalization Act. The proposal that I have would take it up to $1 billion, so banks under $1 billion in assets that are highly rated could move to that 18-month exam cycle. So I appreciate the recognition that that might be appropriate in a good area of agreement between those of us who want to see regulatory relief and the regulators, and I'd encourage you to continue to take that position. Just really quickly, with the time remaining, let me turn to Mr. Silberman and indirect auto lending guidance. Was the Bureau's objective to change the behavior of many of these auto lenders?
No, sir. The Bureau's objective was to allow the indirect auto lenders. I'm sorry, could you repeat the question?
Yes, the question is, was the Bureau's objective in the guidance, in the bulletin, was it to change the behavior of auto lenders?
So if we're talking about indirect auto lenders, the Bureau's objective was to...
Not dealers, lenders within your jurisdiction.
Indirect auto lenders, right. So yes, the Bureau's objective was to let the indirect auto lenders know our understanding of the law, so that when we came in...
Why are you doing that so that you can change their behavior?
It depends on what their behavior is, sir.
Okay, so if this is just a restatement of existing law...
Yes.
You're not trying to change behavior. If you're trying to change behavior, you're in violation of the Administrative Procedures Act because you're not doing this through notice and comment rulemaking. And I would submit that you violated the APA on this, and I would encourage you to do a rulemaking on this. I've run out of time, but appreciate the Chairman's indulgence.
Yep. And I'm going to now renege a little bit. I'm going to allow the gentleman from Wisconsin, Mr. Duffy, two minutes for the final question.
Ms. Eberle, you've indicated that you have reviewed the OGR report. I appreciate that, and I think you've seen a number of emails in there that are pretty damning to the FDIC, and they're targeting payday lending. One of them from Thomas Dujinski, the regional director from Atlanta, as you've indicated, part of the senior team, and who answers to you and to Chairman Gruenberg. In one of those emails, he says, I am pleased we are getting the banks out of payday bad practices. Another bank is griping, but we're going to be doing good things. There's a number of emails in here that are very clear that top management at the FDIC is targeting payday lending and some banks and ammunition manufacturers. And you've seen that report. And then to come in here when I've now provided you the documents that have come from the FDIC and go, I have no idea that the FDIC was at a high level targeting payday lending. I'm surprised by that. And I guess I would like, if you've seen these emails and you now have the documents in front of you, do you still say this is not a senior management issue where we're targeting certain lines of industry through the FDIC?
So the question that you had asked me previously was whether the FDIC included lists of prohibited customers in consent orders and MOUs. So neither of the documents that you've given me are FDIC documents. They're documents sent from financial institutions to the FDIC.
My question is, they're from regional directors.
No, they're two regional directors. They're letters from
so
financial institutions.
in regard to the emails and the exchanges that have been made by Dujinski from Atlanta in regard to payday lending, have you seen those?
Yes, I have.
And are you surprised by that, or did you give him that directive?
No, I was very surprised by that.
So what consequence happened to Mr. Dujinski? Was he fired?
Mr. Dujinski
retired, right?
Yes.
Right. No full benefits, full pay.
Mr. Dujinski's retired.
Mr. Lowe in Chicago, any action taken with him?
So if you're referring to the letter that Mr. Lowe issued, in response to that, we issued a clarification to the industry to make sure that our policy was clear, not just to the industry, but within our organization. And our IG is investigating
So Mr. Lowe was unclear
totality of the matter, and they will make a presentation at our board level, and a decision will be made.
I yield back.
I thank the gentleman. The time of the gentleman has expired. I'd like to thank our witnesses for their testimony today. Without objection, all members will have 5 legislative days within which to submit additional questions for the witnesses to the chair, which will be forwarded to the witnesses for their response. And I would ask the witnesses to please respond as promptly as you can. Without objection, all members will have 5 legislative days within which to submit extraneous material to the chair for inclusion in the record. And with that, this hearing is adjourned.